by over $1 trillion a year. Treasury yields drop as the markets digest the Fed's path forward. We get the account of the ECB's March meeting later. Plus, more sanctions. The U.S. slaps new penalties on two of Russia's biggest banks. Italy also says it would support a ban on gas imports if the EU is united behind it. We'll be live at NATO as foreign ministers meet. Now, first thing is first, let's check out the futures. But as we were just saying, it's really markets still digesting some of the plans that we heard this week from the Federal Reserve, paring its balance sheet by more than $1 trillion a year while hiking interest rates. Now, how it's playing out for the moment, European stocks actually finding a bid, so they definitely paired the losses that we saw yesterday. How the day develops is anyone guesses, but it's very clear now that the roadmap for reducing the assets that they bought during the pandemic was pretty much clearly spelled out by the Fed in minutes of their March meeting. That's when, of course, officials raised rates by a quarter point, and now we see how it plays out, whether this roadmap is something that the markets can get behind or whether they still have a lot of questions. Now, markets getting behind for the moment. If you look at the IBEX over in Spain, getting some 0.4%. I'm looking at the FTSE. Look, it's pretty much unchanged. The focus today, of course, on what's going on in NATO and whether we're going to see more sanctions towards Russia and the ripple effect, the second round and third round effects this has in Europe. Commodities, for the moment, iron ore, one of the biggest gainers since the war started, down 2.5% at the moment. Gas oil pretty much unchanged. Gold also unchanged. And then a lot, of course, of movement we saw in sovereign bonds. Swissy 2-year there minus, well, still negative territory at minus 0.1. Italy 0.3. So we have a look exactly at one of the other movers we should be looking out for. Always look at oil. Oil is always a good idea. First of all, to give us an indication of what we're looking and how we're monitoring the possible oil embargo. We don't have that yet, but if you look at the rationing up of sanctions, it'll be interesting to see our Maria Tadeo and her thoughts on that. If slowly we go into further sanctions at some point, that will be the big bazooka. Markets may readjust ahead of it, or actually it could be a surprise. Brent, for the moment, 102.34. Now let's also get over to our Bloomberg MLive managing editor, Mark Cudmore. Mark, good morning. There's been debate over what exactly is the inflation hedge in this environment. What's your take?
Good morning, Francine. Yes, I'm going to show you a chart of break-evens in the US versus the S&P 500. And I think investors are using this as a reason to think that the S&P 500 is a great inflation hedge. And this is one of those naive overlay charts that you shouldn't believe. So the white line here is US 10-year break-evens. That's a market measure of inflation expectations over time, derived from the spread between nominal yields and, nominal bonds and Treasury inflation protected securities. So now the blue line is the S&P 500. Now, over the last 20 years, these two things had no direct correlation. Obviously, inflation expectations were generally in a range between 1.5%, 2.5% over that period. Meanwhile, the S&P 500 was growing. Suddenly, in February 2020, they both collapsed. And this is when they became joined at the hip. Now, this made sense initially. We'd had the biggest economic shock in 100 years to the economy, and therefore we're worried about a massive deflationary cycle. We got an extreme policy response, both fiscal and monetary, and that meant suddenly we were worried about inflation again, and that was driven into financial assets. So they became joined at the hip at February 2020. It made sense to stay joined at the hip for some period of time. We can debate exactly how long, maybe a year or so. But as of about the last year, it's become abundantly clear that we have a real inflation problem. The supply side inflation problem is translating into a bit of a demand-led inflation problem as well. And that's when you need a real inflation hedge, something else here. And people are using this naive overlay to say stocks are the ultimate inflation hedge. Now, value stocks make sense as an inflation hedge, but growth stocks don't make sense. They do depend on a very, very low discount rate, and they also depend on the fact that inflation is eroding that value of the future growth, future earnings. So therefore, the S&P 500 is massively weighted to these growth stocks, these big, large cap names, and I think that investors are looking at this, seeing stocks as a great inflation hedge, and they're going to become very disappointed later on this year.
Mark, thanks so much. Great chart there by our Bloomberg MLive managing editor, Mark Cudmore. We'll also push it out on social media. Now, the Federal Reserve, as we were saying, outlined plans to pare its balance sheet by more than $1 trillion a year while hiking interest rates, a campaign to curb inflation that could actually hit economic growth. Fed leaders have been signaling for some time that they're prepared to act more hawkishly.
My colleagues and I may well reach the conclusion that we'll need to move more quickly.
Faster is better.
An extremely aggressive rate path is appropriate today.
If it's appropriate to raise interest rates by 50 basis points at a meeting, then I would think that we should do that.
50 basis points is going to be an option that we'll have to consider.
Maybe if 50 helps, you know, I'm open-minded about that.
50 basis point moves would definitely be in the mix.
If we need to do 50, 50 is what we'll do.
I don't think 50 basis points should be off the table.
It could be 25, it could be 50, it could be 75, it could be 1.
I have everything on the table right now.
A series of deliberate, methodical hikes.
And by starting to reduce the balance sheet at a rapid pace as soon as our May meeting.
The economy is very strong and well positioned to withstand tighter monetary policy.
Well, let's get into the key market drivers with our markets editor, Christina Keener, and Richard Dunbar, Aberdeen, head of multi-asset research. So thank you both for joining us. Christine, to you and the key takeaways, of course, from the Fed, the balance sheet runoff, and of course, how that squares with a rate hike, the market trying to get through that.
Absolutely, Francine. I think just listening to that, the package of various Federal Reserve policymakers really hammering on the point of 50 basis point rate hikes. And then, of course, the clarity on the balance sheet runoff plan from the minutes yesterday, a $1 trillion pace each year. That's a $95 billion pace each month. I think initially the reaction was a little bit of relief because I think there were expectations for maybe over 100 billion pace monthly, but that's still quite a hefty pace. And I think the key point as well from yesterday, apart from the pace, is the fact that some members of the committee actually saw it appropriate to not have any caps on the monthly pace, which is quite hawkish, especially if you put that together with their thinking on interest rates, which is still very much 50 basis points, maybe 1, maybe 2, multiple rate hikes on the table.
So, Richard, how do you look at this? And actually, where do we end up? We had also that great Mark Cudmore chart looking at whether stocks, you know, rightly or wrongly, could be the ultimate hedge. And of course, it depends on what industry you're looking at.
Well, indeed. Well, I think we, as we heard from that montage, we need to listen carefully to what the Fed are saying, and the Fed are very clearly saying they are going to lean against the inflation impulses we're seeing. We're seeing downgrades in growth in Europe, in some areas of Asia, in the UK. So I think there was some hope a few weeks ago that we'd see some alleviation in some of that resolve from the Federal Reserve and from other central banks. We're certainly not going to see that. So I think it's reasonable to expect they're going to continue to lean against that inflation. How one builds portfolios, given that perspective, because we're seeing slowing growth, we're seeing some effectiveness of the interest rate rise as a tightening financial conditions, and we're seeing some impact on earnings. So some of the value stocks we were talking about a few moments ago, some of those are coming under pressure, particularly in Europe and other areas of Asia. So difficult to build portfolios.
But so, Richard, what does that mean for bonds? Or is there anything that looks attractive at the moment?
Well, certainly we've seen a huge sell-off at the longer end of the Treasury market and indeed across global bond markets. I suspect if you believe the rhetoric of the Fed, which I think would be reasonable to do so, and you think that the Fed are going to get inflation under control and are going to, in due course, bring inflation into target, there is value appearing at those ends of the bond market. And certainly we're seeing some nibbling in those at that part of the curve. And some of the credit markets have some of the lower quality credit markets have blown out reasonably widely on the back of some of the concerns on growth expectations, and there's selective opportunities there. But I suspect as we tiptoe through this, quality probably is a watchword, both in equity and the broader credit markets.
Christina, I also want to talk a little bit about oil and the broader commodity complex. And actually, I think I have a viewer just wrote in looking at some of the dynamics in complex. I love when viewers write in, so please keep them coming. You can use IB Chat TV Go. When you look, Christina, what's happening in oil, so we have the stockpile releases, and I guess that makes it easier to go through some possible oil embargo. But what's the end point? We're in the summer months. Is it really the winter that we should worry about?
There are lots of factors, of course, Francine, all of these, the usual factors that we look at for oil in terms of that demand picture, definitely very important. And then, of course, add to that just the current geopolitical situation. I think, it's a little bit difficult for me to see now a straight upward line for oil at the moment, just because of the balance of the various factors, because like we were seeing this morning, while there is still always a risk of more sanctions and even tougher sanctions, we're also seeing Russia finding ways to get around those sanctions and to keep the oil flowing. And that really was what was keeping the pressure, the upward pressure on prices over the past month. If that factor kind of fades away a little bit, combine that with the reserve releases, it seems like, again, the path of least resistance for oil at the moment is a little bit to the downside here.
Richard, where do you see the path forward for commodities? And actually, the viewer is writing in saying, look, the Fed is raising rates. We know that. It's been telegraphed. At the same time, there's going to be demand destruction if we look at a possible recession, or certainly our income spending being severely to the downside. So what's the case for a commodity rally, or certainly commodities being supported?
Well, certainly when you look at the broader commodity complex, some of the trends that we're seeing at the moment in terms of the commodity complex have been in place for some time. So lack of supply in oil and some of the hard commodities, weather patterns in some of the soft commodities. So Ukraine and the sanctions around that have exacerbated those problems, but those problems were there and those problems still exist. Your viewer is absolutely right in terms of the expectation of global growth. The expectations for growth are coming down. That is not going to be helpful to the broader commodity complex. But I suspect the mix means that we're going to see a volatile price around these levels. But I suspect the risk is still to the upside, given the continuation of the trends we've already seen and the likelihood of tightening sanctions around the Ukraine issue.
Yeah, and I guess the other, factor is that China for the moment is in a semi-lockdown. When that opens, then we can see a significant demand also for some of the commodities. Christine, thank you so much, our Bloomberg editor for markets, and stay with us, Richard Dunbar from Aberdeen. Now, let's also have a look at two stocks that we're watching, Euronav and Frontline. Those share prices, big potential M&A news from the shipping industry. We understand that Frontline and Euronav are signing a term sheet on potential combination. Euronav gaining 10%, Frontline down 2.1%. Coming up, the U.S. announces new sanctions targeting two of Russia's biggest banks and President Putin's adult daughters. That story is up next, and this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Welcome back to the Open, everyone. 13 minutes into the European trading day, and you can see a lot of these European stocks holding on to their gains, gaining some 0.5% overall. Of course, some of traders trying to stabilize or actually try and understand exactly what the implications of a hawkish Federal Reserve mean for their portfolios and what the ultimate inflation hedge maybe in this environment is. Now let's get the latest on the war in Ukraine. The U.S. has announced new sanctions that target two of Russia's biggest banks, and President Vladimir Putin's adult daughters, as President Biden accuses the Kremlin forces of committing major war crimes in Ukraine.
Just in 1 year, our sanctions are likely to wipe out the last 15 years of Russia's economic gains. And because we've cut Russia off from importing technologies like semiconductors and encryption security and critical components of quantum technology that they need to compete in the 21st century, we're going to stifle Russia's ability and its economy to grow for years to come.
Well, NATO foreign ministers are also in Brussels today to discuss the war in Ukraine. Bloomberg's Europe correspondent Maria Tadeo joins us now from NATO headquarters. So, Maria, NATO's Secretary General warning that we're entering a crucial phase in the war. How will NATO allies respond?
Yes, Francine, and we heard it from the Secretary General today very clear. He says this break that the Russian army is taking now, it's purely tactical. They want to regroup and rearm and then focus on the east, potentially looking to take the entire Donbass. And Francine, what we see now is that this is a war that has entered its second month. It's a sticky war for Russia. It's also an expensive war. But Francine, even more important, the time is ticking for Vladimir Putin. Remember, there's this big parade happening on May 9th. This is the big celebration for Russia, is the end of the Second World War, their big defeat of Nazi Germany. For them, it has a very important emotional component. And remember, this operation happening right now, the Russians say they're only doing it to denazify the country. So Vladimir Putin has to be in a position where by May 9th, is able to present the Russian public something. For NATO officials, of course, that means that the fighting now is going to continue and potentially take an even more aggressive take in the east of the country, particularly around the Donbass, but also looking to create that very strategic corridor all the way down to Crimea.
So, Maria, the Ukrainian foreign minister has also joined the meeting. He arrived about an hour ago. What will NATO foreign ministers try to do? Is it reassurance? What are the kind of talks that we can expect?
Well, Francine, we also heard, of course, from Kuleba today. This is the Ukrainian foreign minister who's attending this meeting, by the way, in person. And he said the time for reassurance is over. It's very clear for Ukraine. They've had a big reality check on this, that NATO is not going to fight this war on the ground. But he says at this point, what we need is big weapons. He says this big distinction that NATO makes between defensive and offensive weapons, he said, is, quote, at this point, silly. It's stupid. The entire Ukraine is defending itself. So therefore, we need the heavy weapons. So the focus from the Ukrainian foreign minister is to walk out from this meeting with a clear pledge from NATO that we are now going to see heavy tanks, potentially also missiles. Remember, the fighter jets too is something that Ukraine has asked for weeks. He wants to come out of this meeting with a clear signal from them that he will get it.
Maria, thanks so much. Our Maria Tadeo there at, of course, NATO headquarters in Brussels. Now, let's get back to Richard Dunbar, Aberdeen, head of multi-asset research. Richard, there's a lot to go through. We talked a little bit about the Fed balance sheet, and I want to go back to that. And, of course, what kind of sanctions means for oil and, therefore, the feedback loop of inflation. But first, let's go to the Fed balance sheet. And it kind of, shows us a progression that we had over the last decade or so. Real yields are finally rising. Richard, what's the key takeaway or implication for the bond stock rotation?
Well, real yields have to rise. The Fed has stated policy is to lean against inflation, both by using its balance sheet and by using monetary policy more generally. In order for that to work, real yields have got to rise. We've got to slow demand and got to slow the economy and got to lean against that inflation. So that's cause and effect. That is starting to work for the Federal Reserve, and that's what they will be looking for. In terms of what that means for stock and bond selection, it's a difficult choice in essence, because we're seeing a Fed leaning against inflation, slowing growth, with obvious impact on revenue opportunities for companies, and we're seeing that coming through in some of the statements coming from companies, particularly those in Europe and those in Asia, to a lesser extent those in the US. So we're seeing earnings expectations come down slightly from the corporate sector. I think the bond markets are starting to accept that leaning against inflation has real resolve from the Federal Reserve. So we might see opportunities within the Treasury market and within some of the higher quality credit markets. But that balance between slowing growth, which is what the Fed is looking for, slowing demand, and the implications for lower quality credits and indeed the broader earnings expectations for the market, I think is a tricky mix.
So if you look at, what we heard from the FOMC minutes, the runoff from May, but then also this quick ramp up, was it more hawkish in your eyes than the market is even interpreting today?
I think it probably was as hawkish as the market is currently interpreting, if you like, but a lot more hawkish than I think some of the views that were expressed even a few weeks ago. I think there was doubts about the Federal Reserve's resolve in terms of its decision its policy to lean against inflation, and doubts about whether what's going on in Ukraine and the broader problems around the war there, whether that would cause some alleviation in some of the tightening policies that we've seen both from the Fed, from the ECB and from others. But that's obviously not the case. And market expectations have moved very quickly to a Fed with some resolve. And that's exactly what we're seeing, and that's exactly what the minutes demonstrated last night.
Richard, thanks so much. Richard Dunbar there, Aberdeen head of multi-asset research. Now coming up, Bridgewater wins big, while some others suffer brutal reversals. Hedge funds in focus next. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Welcome back to the Open, everyone. 23 minutes into the European day. For the moment, you can see these stocks actually supported by what we heard. Well, not by what we heard from the Fed, but actually they're trying to digest what we heard from the Fed. And after the losses yesterday, there is a little bit of a bid. Investors trying to figure out the implications of a hawkish Federal Reserve. Now, the other story, and we do have quite juicy corporate stories, is Atlantia, jumping some 11%. Now, yesterday, there were a number of people that were looking at some bids. There was a report that Blackstone was looking at it, GIP, Brookfield, ACS as well. We don't know exactly where this ends, but again, it's owned for the moment by Benetton, and they're putting Blackstone versus Florentino Perez, one of the biggest deals for the country. Now, it's also focused on the hedge fund industry. Ray Dalio's Bridgewater posted a 16.3% return in the first quarter, while Glenview Capital's flagship hedge fund rose 5.9%. Tiger Cubs suffered a brutal reversal amid 2022's market turmoil, losing money on their favorite trades of tech giants and unicorns. Well, joining us now for more is Tom Metcalf from our finance team. Tom, this is fun. You go through like the list of what hedge funds did, what they got wrong, and what they did right. It's a bit like a bracket for nerds. Who are the biggest winners and losers?
Yeah, so it kind of splits out between two types of hedge funds more than anything. So on the one hand, it's sort of those equity-focused hedge funds, and in particular the Tiger Cubs, who are very tech-heavy. Obviously, that sector's had a real rough ride, and they are down, you know, a lot by sort of double-digit returns. But then on the other side, you're seeing some absolutely astonishing returns on the macro hedge fund side. So, and funnily enough, those funds are the ones that have struggled over the past few years, and now as you hit all this volatility, you are seeing some like unbelievable returns.
I mean, yeah, some of the returns are really quite astounding. Is there like a winning bet or a type of winning bet that you could, you know, identify a pattern across the board?
So the one that really jumped out to me when I was looking at all these stories was the Hadar Capital Management. So that's up 148% so far this year. And yeah, it looks like they kind of went heavy into commodities, heavy on sort of interest rate movements. And, you know, those high conviction bets, they're the ones that are really paying off.
Yeah, so you have to understand that most mornings I go over to Tom's desk and I annoy him about some of the things that we're looking amongst bankers. We're both really excited because the FCA head is coming for his first TV interview, an exclusive interview, after they set out, it's not really a strategy, but they're actually looking out to, you know, be more targeted, measure success, but also hire more.
Yeah, exactly. So he's been in the post since the pandemic, during the pandemic, and this is, his, I think, his real first big TV appearance. So I'm going to be watching very closely. And as you say, today what's come out is a sort of a 3-year plan for the FCA, which sort of builds on what he said before. But for me, the interesting thing was, you know, they're really going to look at sort of hitting firms that fail in very quickly. So they're hiring something like 80 people, so a whole new team there to sort of clamp down on that kind of stuff.
Yeah, and there's also social media aspects. I think they're going after some of the ads, for, you know, on Twitter and the other one. So we'll have a chat about that. Tom, thank you, our European finance editor. Now, don't miss this exclusive interview, as Tom and I were saying, with the FCA Chief Executive, Nikhil Rathi. That's coming up in the next hour. Coming up shortly, though, more on the war in Ukraine. We assess the impact of the energy supply shock with Alex Brazier. He's managing director at BlackRock. In the meantime, European stocks are for the moment still climbing, and markets working through the Fed's plan to pare its balance sheet by more than $1 trillion a year while hiking interest rates. Now, it's very clear that we have a roadmap. The roadmap for reducing the assets they bought during the pandemic was really spelled out yesterday. Officials raised rates by 1/4 point in March. The big question now is what happens in May. So we'll have a full, thorough look through at some of these European stocks and, of course, what that also means for bonds. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor, y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Time to shrink. The Fed lays out plans to reduce its balance sheet by over $1 trillion a year. Treasury yields drop as markets digest the Fed's path forward. We get the account of the ECB's March meeting a little bit later, plus more sanctions. The U.S. slaps new penalties on 2 of Russia's biggest banks. Italy says it would also support a ban on gas imports if the EU is united behind it. Now, quickly, let's also check on what the markets are telling us. Yesterday, we did have a sell-off as the plans for what the Fed will do really came at the forefront. Commodity markets, I would suggest one of the most interesting bits of the markets, as always, continuing to be whipsawed by disruptions sparked by Russia's war in Ukraine, and of course efforts to curb some of the raw material costs. Oil rallying, pairing a slump that was triggered by the IEA's decision to deploy some 60 million barrels for emergency stockpiles. Now that's all feeding through some of these stocks, and if you look at the sectors that are moving the most, it's extremely interesting to see some of the commodities, some of the other things that we're watching out for. So for example, I think we have energy on the way down. Mostly, a lot of these are on the way up. We're also looking at live pictures from headquarters of NATO. Foreign ministers beginning their meeting. Our Maria Tadeo is on the ground. We'll have plenty more on that. And we're also expecting, those are live pictures coming in. We're also expecting the NATO Secretary General shortly to be addressing. It was extremely interesting to hear the Ukrainian foreign minister, as he was walking into the meeting, also giving an address to journalists gathered around him in English. Now, let's focus on the impact the war in Ukraine is having on global energy policy. In a drive for energy security, the West seeking to wean itself off Russian oil and gas. Now, this presents a fresh supply shock in an already tight market. Well, Alex Brazier is deputy head at BlackRock Investment Institute, and he joins us now. Alex, thank you so much. I've been actually looking around for a piece of research like yours for the last couple of days, just to try and understand if there's an oil embargo that could come quite suddenly, what happens to energy markets? And you lay it out very clearly. A couple of scenarios that you're looking at. What's worst case scenario?
Well, good morning, Francine.
Good morning.
Thanks for having me. I think there are really 3 scenarios we're thinking about. The central case is that a determined reduction in the West's reliance on Russian energy is now baked in. That's a done deal, regardless of what happens on the ground in Ukraine. There are risks to the downside there, as in a faster reduction in the West's reliance on Russian oil and gas. And you see this morning news from Europe about more determination to reduce imports of Russian oil and gas, and that would result in even tighter markets. We don't see that much risk of a less determined reduction now, regardless of what happens on the ground. So tight energy markets are here to stay, with risks skewed to the upside, we think.
So how tight can they be? If you look at, if there's a recession, and I don't know whether we're inching towards it with a lot of the sanctions, but also possible mistake from some of the policymakers, does it mean that automatically there's going to be demand destruction across the commodity spectrum?
Yes, I think so. And really what we're looking at here is a classic supply shock. Energy prices remaining high in tight markets. And although it's not the 1970s on a global scale, the world is less reliant on oil and gas than it was then. For Europe, the risks of stagnation now are very serious. Low stagnation, possibly recession as well, at the same time as high inflation. So Europe now faces serious risks of recession and stagnation.
So what's the right policy mix to deal with that?
Well, in Europe, the ECB can't really now be relied on, given that it's facing high inflation, to come to the rescue. All eyes really should be on fiscal policy, and although we saw some noise there a few weeks ago, actually we haven't seen plans forthcoming. Hence, we think the downside risk to European growth. The ECB is in a real dilemma now. Prior to this, it needed to normalize policy, get rates out of negative territory. The restart didn't need additional stimulus. But now the ECB may find actually that this slowdown that's coming, and you see it now in the PMI surveys, this slowdown that's coming may do some of its work for it. But there's no getting around the fact that the ECB faces a real dilemma here.
Alex, why do you think fiscal plans have been a little bit shortcoming, or they're certainly not forthcoming? Is it because it's a lost case scenario if there's some kind of oil embargo? Are they gaming worst case scenarios? Or is it after 2 years of COVID, they feel like they can't really spend their way through this?
Well, it's difficult to say. I think partly it's not yet clear the scale of the slowdown Europe is facing. I think when we look at this and crunch the numbers, we think this energy shock could knock 2 to 3% off the level of European GDP by the end of the year. So even with the momentum from the continued restart, Europe is getting close to zero growth on an annual basis.
So what happens to some of the energy supplies? I know we were talking about, the IEA putting extra stockpiles. We talk a lot about renewables, but again, we sometimes don't have the components to make that transition possible in the timeline that the EU has set out.
Yes, and so the main plan is the determined plan to reduce reliance on Russian gas imports over the next year by 2/3. But even with energy conservation measures, even with a delayed phase out of nuclear power, Europe will rely on increased imports of LNG from other sources. And really what we're seeing here, or going to see, is a shift in where fossil fuels are produced, away from Russia, where assets are effectively being stranded, and towards other places like the United States and Canada.
Are we underestimating this in the markets? Stocks are looking at metrics and they seem to be powering ahead. I know it's very difficult to get a return, so I understand their dilemma. But given what you're saying, maybe they should, have a bit of a correction.
Well, we remain overweight equities as a whole, but within that, we're not overweight European equities because we think this growth slowdown that we're looking at now in Europe isn't fully reflected in relative valuations.
Are we underestimating the political splintering? I know we have French elections, and in the last couple of days, that Marine Le Pen has been doing quite well. What are some of the secondary and third-time effects of this uneasiness in Europe that we're seeing?
Well, I think, first of all, we'll see European equity markets underperform for a period, hence why we're not overweight European equities as we are other equities. The uncertainty will persist for some period of time. I think what we need to look for is whether there's fiscal action, whether any fiscal action comes along, and we need to look to the ECB for signals about whether it still remains determined to get rates out of negative territory, even as growth slows.
So, Alex, where does China fit into all of this? I mean, a lot of questions about, of course, this maybe newfound friendship between Russia and China, but also China's diverging from the rest of the world in terms of some of the policies they're putting in place.
Yeah, I think two things about China now over recent weeks. The first is that downside risks to growth in China this year have increased. It seems that the cost of COVID control and the lockdowns is going to be greater than many had anticipated. And so the chances of hitting that around 5.5% growth target are now slimmer than they were. At the same time, we see increasing numbers of international investors demanding a higher risk premium for investment in China. Now, that's partly why a higher risk premium has been priced in so far this year, and we think that explains in large part the relative performance of Chinese stocks over the course of the year to date.
Do you expect them to stay with their zero COVID tolerance policy?
Yeah, I think so, but the definition of zero COVID is increasingly flexible.
Right.
But nevertheless, with an elderly population that isn't fully vaccinated, as say in the West, the Chinese authorities face a difficult choice. Where they have COVID outbreaks, they will need to be controlled as they are now in Shanghai, and that has a serious cost on economic growth.
Does it reshift? And I know part of our supply chains had already shifted under President Trump, but does it continue shifting because of what's happening in China?
Yeah, partly because of what's happening in China, and partly because of the Russia situation as well. We will see, I think, a rewiring of global supply chains, perhaps into different poles, west and east. But that remains to be seen. What we are facing now is a world dominated by supply shocks. We've been through a period where supply wasn't the main factor. Post the pandemic, we're in a world driven by supply, and that presents central banks with a real dilemma, because either they have to live with higher inflation or they have to raise rates to levels that would destroy demand, raise unemployment in order to squeeze inflation down. And that's the dilemma they haven't really been faced with for a very long time.
And the Bank of England probably has it harder than anyone, given, I mean, so there's not much reliance on, you know, Russian gas and oil, but at the same time, because of Brexit, it's more difficult to deal with inflation because you have labor shortages and so wages go up.
Yeah, the UK clearly faces a number of supply shocks. One, as you say, as a result of Brexit, the other as a result of rising energy prices and particularly gas prices. So the Bank of England has been, in the face of that, sprinting towards neutral, removing stimulus, which makes absolute sense, as it does for other central banks as well. The interesting question is whether the bank, and indeed the Fed, go further than taking their foot off the gas and actually slam the brakes to slow demand.
Alex, we'll see. Thank you so much. Great insight. Alex Brazier there, Deputy Head at BlackRock Investment Institute. Now, we're still looking at live pictures from NATO headquarters, foreign ministers beginning their meeting. So you can see a couple of them in very serious conversation. And then I think we'll hear from a lot of the foreign ministers as we go around the room. Coming up, we talk about inflation and Russian sanctions with the Piraeus Bank Chief Executive Christos Megalou. Don't miss that exclusive interview. It's coming up next. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Welcome back to the Open, everyone. 42 minutes into the European trading day. We're still seeing support for a lot of the European stocks. They're climbing, but not as much as they were just minutes ago. So European stock 600, you can see gaining some 0.3%. Again, if you look at U.S. futures, they're also stabilizing, and investors trying to digest the implications of a hawkish Federal Reserve that we had yesterday. We're also looking at live pictures from NATO headquarters in Brussels. Foreign ministers due to begin their meeting. That is, you can see, well, moments ago, you could see the foreign minister of Ukraine, who also gave a short, brief statement in English to reporters gathered around him as he was walking into the meeting. Now let's turn our attention to Greece. The IMF says more efforts are needed to rebuild resilience in the country's banking sector as the war in Ukraine and mounting inflation persist. It comes as Piraeus Bank, one of the Greece, well, one of Greece's largest lenders, announces its new business plan. Well, I'm delighted to be joined by Christos Megalou, Piraeus Bank Chief Executive, who joins me now in the studio. Thank you so much, sir, for joining us. First of all, congratulations, because you've been managing to meet with investors and came up with this new plan. The most interesting bit, I think, is that we could see dividends in 2024. Does that mean that the worst is behind us?
It does. There has been a tremendous amount of work that we have done at Piraeus Bank, Francine. And good morning.
Good morning.
Thank you for the invite. Very pleased to be back live in a studio. The bank has done a tremendous amount of work in reducing non-performing loans, which was the main task. We are looking in 2024, 2025 to be below the European average in NPEs. And this gives us a green light for a number of things, including dividends, subject, of course, to regulator approval and capital trajectory. But we feel despite the headwinds and despite the current situation, that Greece is going to be growing this year. The IMF was talking about 3.5% growth, and that will be reflected in our numbers.
But how worried are you about inflation? So the war in Ukraine, of course, changes everything in terms of the price of oil, in terms of inflation, in terms of the cost of living. How worrisome is that for households in Greece right now?
We are taking into account that inflation this year will most likely be as high as 6 to 7% in Greece. And that, of course, will have an effect on disposable income. However, we think that this is going to be normalizing in closer to the 2 to 3%, close to the European average, to the European rate. And we think that this is going to be the norm from 2023 onwards. So we take that into account in our plan, and we have budgeted accordingly, and some of those headwinds had been actually included in our plan.
Is it frustrating? And if we look at the share price, it's been, you've had a very tough ride. Is it frustrating that you seem to be doing better now, leaving some of, the things behind you, but actually there was also a general strike on Wednesday to protest rising prices, so that, there are things outside your control that can make it much more harder going forward?
Well, that's always a challenge for a CEO and for a financial institution that has quite a large stake in the Greek economy. We are confident that the way growth is going to be coming up this year, and that's very important because all the economic commentators are projecting growth of something between 3 to 4%, will help us ride the wave, and a lot of the inflationary pressures, but also the push for disposable income will be addressed.
What's your take on the tourism sector? That, of course, is extremely important to Greece and then feeds also what you get into the bank.
That's a very important part of 2023 GDP growth for Greece. Tourism, and I'm glad to say that, with all the work that we have done with a lot of our clients and a lot of people that are very big in tourism and hospitality in Greece, is going to be a positive surprise for Greece. People are expecting that it could be revenues from tourism and hospitality sector as high as 2019, which was the best year ever.
And this despite the war.
And this despite the war. Obviously, after the years of pandemic and everything that is happening, this is plays a role in people's thinking and wanting to go on holidays and so on. It looks like Greece is going to be benefiting from that, and we hope that with about 19 billion of receipts, this is going to be a GDP growth underpinning the 3.5% that people are thinking it's going to be coming this year.
I just want to bring the viewers' attention also to the fact that over at NATO headquarters in Brussels, we understand that Mr. Stoltenberg has just started speaking, so we'll keep an eye on what he says. Mr. Megalou, do you see any banking opportunities for mergers in Greece or even cross-border at the moment?
Right now, I think all the Greek banks are doing a tremendous amount of work in order to produce profitability, and each one focusing in its own business model and in its own way forward. We have announced with our business plan a very elaborate plan for growth based on the asset management business, on our real estate strategy and our digital. And our focus is to grow organically over the next few years. That's the pillar of the 22-25 plan.
Christos, thank you so much for joining us. Christos Megalou there, the Paris Bank Chief Executive Officer. In the meantime, Mr. Stoltenberg of NATO has just started speaking. Let's listen in.
It is important to hear directly from you, Dimitro, and discuss the way forward. This concludes the public part of this meeting. I thank the media for joining us, and then the meeting will continue in just a moment. Thank you so much.
All right, we just got the tail end of that, of course, as we heard from Mr. Stoltenberg saying that they allowed a bit of the public, of course, NATO meeting because they had the Ukrainian foreign minister, and then they'll go back to their proceedings behind closed doors. Now, Emmanuel Macron is spending the final week before France's presidential election this Sunday, trying to connect with voters through campaign stops and media appearances, as polls show the gap between him and far-right leader Marine Le Pen narrowing. Now, the latest surveys show that Macron would beat Le Pen by 53% to 47% in a runoff on April 24th. Here's what Marine Le Pen had to say about two of her political adversaries.
Ce sont exactement les mêmes.
They are exactly the same. Valérie Pécresse had been considered at some point to become Macron's prime minister. She could have been without difficulty. They have the same political DNA. They think the same about Europe, the economy, free trade. They think the same about everything.
Ils sont tous les deux mondialistes en réalité.
They are both globalists. I am national. These are two different views. You have to accept that. It's really the choice that the French will have to decide between the national and the global. So Valérie Pécresse or Emmanuel Macron, it's the same.
Well, joining us now is our reporter in Paris, Caroline Conan. So, Caroline, what has changed in the campaign? Because polls actually now give more, I guess, impetus to a possible Marine Le Pen win. And how tight have the polls been in the past few days?
Francine, you've seen the anxiety on the markets, on the French bonds over the past few days, and the CAC 40 lagging the other European peers over the past months. That's because the polls have been narrowing. The gap between the incumbent Emmanuel Macron and Marine Le Pen is just 5 points in the first round, so it's getting dangerously close. But what's even more worrying for Macron's camp are the second round polls, because at the moment, one recent poll showed that Macron would get about 53% in the runoff 2 weeks after Sunday on April 24, while Marine Le Pen would get about 47%. So there's only a 6 points difference between the two for the second round, when the difference was actually 20 percentage points just 2 weeks ago. So initially, you saw a boost in the polls for Macron after the beginning of the war in Ukraine. He benefited from a so-called rally around the flag effect, appearing as a statesman above the political bickering. But more recently, Marine Le Pen has placed the issue of purchasing power, spending power, the cost of living at the center of her campaign, and given the situation on the inflation front, clearly that's given her a boost in the polls.
Caroline, let me show you actually what some of the French bonds are doing at the moment. And we had a really interesting piece by Bloomberg Intelligence looking at, look, French bonds need to learn how to live without QE, but with a Marine Le Pen risk. So they were looking at through some of the scenarios. And just a reminder, if you look at that, it's basically spreads have nearly doubled in 2022 as investors had discounted the idea that QE, which has backstopped French debt, was ending. So what, in general, if you look at the elections, the first round Sunday and then the second round 24th, could derail market expectations?
So the situation is not as tricky as in 2017, when you had a risk of an extreme runoff between Marine Le Pen and Jean-Luc Mélenchon from the far left. This time the situation is not as bad, but the delicate phase for investors will be between the first and the second round. You have to look at the international situation and how this is going to impact the energy inflation issue, because Marine Le Pen has some proposals, including cutting VAT for fuel, electricity and gas from 20% to 5%. So that's obviously appealing to some voters. So you're going to have to see how Emmanuel Macron can actually respond to this. And you also have to look really closely at the turnout, abstention. The abstention could actually be quite high this Sunday for the first round. Some polls say that it could reach up to 30% of abstention, a level that we actually haven't seen since World War II. And in fact, the last time abstention was very high in 2002 for a first round. That's when the father of Marine Le Pen, Jean-Marie Le Pen, actually unexpectedly made it to the second round.
Caroline, one of the most brilliant opinion pieces comes from our John Authors, who's also putting the spotlight on a possible Marine Le Pen win. I mean, he has at around 1 in 5 chances. What's her appeal in 2022?
So clearly, this piece was very interesting, and John Authors actually says that Emmanuel Macron has about 80% chances of winning this time. So clearly the concern is that there is still about 20% chance that he's not going to make it. So we could see some spread widening between the first and the second round, and you also have to look very closely at what the far left will do on Sunday with the candidate Jean-Luc Mélenchon, who also has some proposals, including capping energy prices, capping some essential food products prices, and raising the minimum wage. So clearly all this putting the issue of inflation and purchasing power at the very top of the concerns of the French before the war in Ukraine, before immigration, or before environment issues.
All right, Caroline, thanks so much. Caroline Conan there, our reporter in Paris. Also, don't miss our special coverage of the first round of the presidential election. We'll be live. This show will be live from Paris from tomorrow, and then we'll be live also as polls close, 7 p.m. UK time, 8 p.m. Paris time on Sunday. In the meantime, we're also getting some, share price movement on some of the corporate stock. If you look at Atlantia, the share price getting some 10%. It did jump on possible reports of a takeover. The GIP, Brookfield, ACS bid, Blackstone as well. So we'll have to keep an eye on that. Markets in general showing signs of a recovery. Again, traders stepping in after a sell-off sparked by hawkish minutes from the Federal Reserve. The other story we're watching out for is Euronav and Frontline. So let's have a look at those share prices. Big potential M&A news from the shipping industry. Frontline and Euronav, we understand, have signed a term sheet on a potential combination. Interesting to see Euronav gaining 8%, but if you look at Frontline, down almost 5%. Now, coming up next, don't miss our exclusive interview with the FCA Chief Executive, Nikhil Rathi. We'll get into financial regulation and their new warning to big tech companies. So that's it for the European Market Open. Surveillance early edition is up next. The global equity markets really dived yesterday after those Fed minutes showed officials were focused on tamping down inflation, but they were also outlining plans to pare the balance sheet by more than $1 trillion a year. Commodity markets really continue to be whipsawed by disruptions sparked by Russia's war in Ukraine and efforts to curb raw material costs. Oil today rallying. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Stifle Russia's ability and its economy to grow for years to come.
Which I think would be a tall order. Yes, it's not easy.
And I expect a series of deliberate, methodical hikes as the year continues. This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. A time to shrink. The Fed lays out plans to reduce its balance sheet by over $1 trillion a year. The U.S. slaps new penalties on two of Russia's biggest banks, and on Putin's daughters, Italy says they would support a ban on gas imports if the EU is united behind it. And stay with Bloomberg Surveillance Early Edition. This hour, we have an exclusive conversation with the Chief Executive of Britain's Financial Conduct Authority, Nikhil Rati. Send in your questions on IB Plus TV Go. Now, first thing is first, let's check in on the markets, and definitely markets taking in their stride after a huge sell-off yesterday about the plan to reduce the balance sheet from the Fed. So there was a sell-off yesterday, sparked by, of course, a more hawkish Federal Reserve Bank. Global equity markets dived after these minutes showed that officials were focusing on tamping down inflation expectations and really outlined a plan to pare some of the balance sheet by more than $1 trillion a year. The mood today is quite different. European stocks still being supported 0.2% higher. We don't know how it plays out because they actually started 0.8% higher. So they're losing a bit of momentum, but it'll be interesting to see what kind of analysis on whether, for example, some of the hawkish messaging is even more hawkish than currently priced in. The other story, of course, is ruble 81.0625. Incredible how the Central Bank of Russia has managed to engineer the ruble so that it didn't collapse, as we saw at the beginning of the war in Ukraine. The FTSE down some 0.4%, but if you look at the FTSE MIB in Italy and the CAC 40 supported, for example, the CAC 40 gaining 0.2%. Now, the Fed signaled that it'll shrink its bond holdings by as much as $95 billion a month. Now, this comes as minutes from March's meeting showed many officials would have opted for a 50 basis points hike, but actually held off because of Russia's invasion of Ukraine. Now, Fed leaders have been signaling for some time that they are prepared to act more hawkishly.
My colleagues and I may well reach the conclusion that we'll need to move more quickly.
Faster is better. An extremely aggressive rate path is appropriate today.
If it's appropriate to raise interest rates by 50 basis points at a meeting, then I would think that we should do that.
50 basis points is going to be an option that we'll have to consider.
Maybe a 50 helps. I'm open-minded about that.
50 basis point moves would definitely be in the mix.
If we need to do 50, 50 is what we'll do.
I don't think 50 basis points should be off the table.
It could be 25, it could be 50, it could be 75, it could be 1.
I have everything on the table right now.
A series of deliberate, methodical hikes.
And by starting to reduce the balance sheet at a rapid pace as soon as our May meeting.
The economy is very strong.
and well positioned to withstand tighter monetary policy.
Well, I also have everything on the table. We're joined by Rebecca Chesworth, Senior Equity Strategist at State Street. Rebecca, do you have everything on the table? I mean, we now have more of a plan. What does it mean for equities?
Yes, it's great. I love those clips. I guess we get it. It's going to be 50 basis points. And certainly, if you're looking at the OIS pricing in the market today, we're there. We know what we're going to see next month. What does it do for equities? Well, in a way, we've moved beyond the data point, so it gives you a little bit more certainty in the markets. And I think it leaves the markets ready to move on to thinking about earnings, so thinking more about those fundamentals, how the companies are surviving at the moment, how companies are responding to this high inflation, what they're thinking about rates. So I think that the market's focus moves on from today.
So, Rebecca, how do you hedge against inflation?
So I think one way of doing it is to be incredibly selective. One thing that we said last year throughout the year was to buy energy stocks, and that really is a call that we're continuing this year. So we're now into our second quarter. We still think that energy is that best way to play inflation. With or without a war, we see these crude oil prices staying high and the energy companies being able to pass that on. If it's not energy, then you either need to think about something else cyclical that has the pricing power, and maybe you can see some of that within industrials, or you go much more defensive like healthcare.
We're seeing a movement, of course, in real rates, Rebecca. What does that mean for some of the valuations that are a little bit on the toppy side?
Well, it means that we have to stay very vigilant still. So the market is down so far this year, but it has recovered somewhat, and therefore valuations remain extremely high. There are parts of the market, such as technology, that remain very reliant on what's happening with rates and with valuations. So I still think that there are parts of the market that we need to pay attention to. And as you say, real rates coming back towards neutral and then positive will have an impact there.
Okay, Rebecca, I want to come back to energy, and of course, the idea that if you look at the commodity complex, then you could also have demand destruction and what that means for the broader markets. Now, let's get also, Rebecca, the latest on the war in Ukraine. The country's foreign minister has pleaded for more weapons at a meeting of NATO allies in Brussels.
My agenda is very simple. It has only 3 items on it. It's weapons, weapons, and weapons. We are confident that the best way to help Ukraine now is to provide it with all necessary to contain Putin and to defeat Russian army in Ukraine, in the territory of Ukraine.
Well, our Europe correspondent, Maria Tadeo, joins us now from NATO headquarters. So, Maria, NATO Secretary General warning that we're entering a crucial phase in the war. How will NATO respond?
Yes, Francine, and the Secretary General was very clear this morning. He says this break that we've seen from the Russian army at this point essentially is about regrouping and rearming and then focused on the east. He says that Russia could be aiming to take full control of the Donbass. A lot of this, Francine, of course, because the clock in many ways is ticking for Vladimir Putin. There is that parade coming up, Victory Day, May 9th. This is the biggest celebration of the end of the Second World War, that Soviet victory over Nazi Germany. For Vladimir Putin, he needs to be able to show his public something. When it comes to NATO ministers today, they continue to say they don't want to escalate. They don't want this war to spill over from Ukraine, but support the country. But you heard it from the Ukrainian foreign minister very clearly. Okay, that is great, but at this point, what we need is weapons, weapons, weapons.
All right, Maria, thanks so much. Of course, I'm Maria Tadeo there at NATO headquarters following that meeting very, very closely. We're back with Rebecca Chesworth, Senior Equity Strategist at State Street. Rebecca, I wanted to go back to this idea that actually if there's a recession looming and it's extremely difficult, of course, in Europe to see a way out of it, then what that means for demand destruction for example, the energy complex, oil, but also others. And so what would support your attractiveness to some of the sectors?
So I think you become more vigilant, more selective, because of course some areas will slow down more than others. I would suggest that you need to be particularly careful about the consumer areas at the moment, so areas such as consumer spending, because as well as the economic slowdown, you of course are seeing consumer balance sheets squeezed. So this was an area that we liked earlier this year, but I think that's off the table for now. So that's one area to be wary of. Of course, you will see some demand destruction, but for where we are now, you're still going to see commodity prices remain high because of that supply dislocation, because of the supply chain problems. So even though you may see demand fall somewhat, you've still got those supply problems keeping that imbalance going. So, and that goes for not just oil and gas, but it also goes for some of your metal areas as well. So there is a sense that we see people looking at the metals and the miners, some of the other material stocks. And then with industrials, maybe there is a segue to think about areas which are seeing demand growth. It's not nice, but we can see increased demand for defense spending out there, for example.
So, Rebecca, when you look at some of the reshoring or some of the supply chain efficiency, I know they've been tested by the Trump presidency, by COVID, and now the war. How much of these supply chains are still left to change and retrace?
Oh, significantly. I mean, we've been living through globalization. It's a 20, 30-year phenomenon. Not to say that that all unravels, but you have had a significant move offshore, and therefore, even if you only bring part of your supply chain, the part that's nearest to you, the part that's most vital back, then that is quite a significant move for a lot of countries and companies in industries. We'll maybe see it start with phones, with cars, with some of their vital components coming back towards the UK and towards Europe.
Is there anything left, though, Rebecca, in Europe that seems attractive at the moment, given all the headwinds and the proximity to Ukraine and Russia?
Very difficult. I'd suggest something like healthcare, which is a defensive area. We know investors are very underweight there, but we know also that institutional investors have been buying. The lack of support for that sector has always been because of the political risk in the US. But now maybe the administration there has got much more important things on the table, and we failed to see that move to restrict the pharmaceutical pricing. So that could be an interesting area.
All right, Rebecca, thanks so much. Rebecca Chesworth there, Senior Equity Strategist at State Street, joining us this morning. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. This hour, we also have an exclusive conversation with the Chief Executive of Britain's Financial Conduct Authority, Nikhil Rathi. Send in your questions on IB Plus TV Go. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Mira GTX is a clinical stage gene therapy company that develops potentially curative treatments for patients living with serious diseases. Listed on the NASDAQ, Mira GTX is focused on diseases of the eye, salivary gland, and central nervous system. The chief executive, Andy Forbes, joined the company in 2015 with a background as a healthcare hedge fund manager. So, Zandy, thank you so much for joining us. This is an interesting conversation, of course, on some of what's at the forefront in terms of technologies. What do you need right now? I don't know whether it's regulatory. I know there are a number of trials at the moment, or whether it's just the price of some of the technology to come down to have this more widely available. And good morning.
Good morning. Thank you for having me. Very interesting question and a multi-layered question. Because gene therapy is a completely new modality of treatment where you use the gene, the message, to instruct the body what to make, which is then your therapy. So early gene therapies often used very large doses, and it was very expensive to make them. And one of the things we did when we first started the company to address this manufacturing cost is bring manufacturing in-house. So we have a manufacturing facility here in London, actually. And in addition to that, over the last 2 years, we've all experienced supply chain issues, and we've recognized the importance for both cost and timing of bringing upstream supply in-house, which we've done, as well as downstream analytics. And that really addresses the cost of the therapy itself, how you make it.
And so, Zandy, when you look at COVID and actually what we've lived through in the last 2 years, we've thought a lot more about our health. And I don't know whether it means that governments, but also private individuals are looking at some of the therapy differently now because we're expecting new social contracts, or whether actually it means that the focus is on the vaccines and on nothing else.
So I think what we saw in COVID is the healthcare system galvanize using new technology that was available because of the investment in biotech and all these new therapies like gene therapy, and be able to come to the rescue of the world with vaccines and new treatments. And I don't think that vaccines are, while really useful and have been incredibly helpful in this epidemic, they treat or prevent infectious diseases. And we're finding and seeing today, post-COVID or just post-COVID, that the world has many large diseases which we still don't have treatments for, such as diabetes, cardiovascular disease, certain types of cancer. And so there is a huge amount of innovation in healthcare. Gene therapy is one of those new modalities that can now be used to address some of those other large epidemics.
When do you think gene therapy will really kind of take off? And again, it's one that you laid out, very consistently in terms of it has to be part of the money, the technology, and things like that. But how far away are we from that in terms of years?
So there are different gene therapies, and we're very close, in fact, to having gene therapies that really make a difference in certain diseases, such as inherited diseases. And 2 products are now approved, which are gene therapies, and we, with our partner Johnson & Johnson, have a late-stage clinical trial in inherited blindness, which should be approved if that trial is successful in the coming years. So it's not decades away. However, one of the things we've done at Mira is develop even newer technology to harness gene therapy in a way that we can use it for diabetes, for brain cancer, and that's probably 4 or 5 years beyond the use of gene therapy for inherited diseases.
And is that, when you speak to investors, is there a part of the world where they're more behind this? And again, I don't know whether it's cultural or just because the information is of easier access and understanding to them.
Investors are, in biotech in general, very, very sophisticated in the US. Our headquarters are in the US. I was an investor in New York. And there is a really sophisticated healthcare and biotech investment ecosystem there that exists in other places, but not as broadly and strongly as in the US.
Sandy, thank you so much for coming on today. Sandy Forbes there, the Chief Executive of Mira GTX. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. This hour, we have an exclusive interview with the Chief Executive of Britain's Financial Conduct Authority, Nikhil Rathi. Send in your questions on IB plus TV Go. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, Emmanuel Macron is spending the final week before France's presidential election this Sunday, trying to connect with voters through campaign stops and media appearances as polls show the gap between him and far-right leader Marine Le Pen narrowing. Now, the latest surveys show Macron would beat Le Pen by 53 to 47% in a runoff on April 24th. Here's what Marine Le Pen had to say about two of her political adversaries.
Ce sont exactement les mêmes.
They are exactly the same. Valérie Pécresse had been considered at some point to become Macron's prime minister. She could have been without difficulty. They have the same political DNA. They think the same about Europe, the economy, free trade. They think the same about everything.
Ils sont tous les deux mondialistes en réalité.
They are both globalists. I am national. These are two different views. You have to accept that. It's really the choice that the French will have to decide between the national and the global. So Valérie Pécresse or Emmanuel Macron, it's the same.
Well, joining us now is our reporter in Paris, Caroline Connaught. Caroline, first of all, what's changed in the campaign? And the polls from Monday got so much tighter. What's happened?
the race has been tightening over the past few days. Initially, you know, Emmanuel Macron benefited from this rally around the flag effect after the beginning of the war in Ukraine. He appeared as a statesman above the political bickering. But then you had another effect of the war in Ukraine. I mean, first, initially, the far-right candidates Marine Le Pen and Éric Zemmour were both considered as pro-Russia, at least sympathetic towards Vladimir Putin. But technically, Éric Zemmour actually took all the blame for his proximity with Russia. He said in the past, for example, that he was dreaming of a French Putin. So the French voters, surprisingly, almost forgot about what Marine Le Pen said about Russia and her proximity with Vladimir Putin in the past. And the second effect was, of course, inflation. The war in Ukraine has fueled energy inflation, food inflation, and Marine Le Pen has put the issue of spending power and the cost of living at the heart of her campaign, and that is paying off in the polls.
Yeah, it's really amazing, Caroline, when you look at, the number of candidates, some of these candidates that we thought at the time could do quite well, and actually how they're polling now. So what exactly is the appeal of Marine Le Pen? I was reminded by Valerie that, of course, last time there was a presidential election, it was all about exiting the EU. Now she's trying to rebrand herself, but of course there's a border plan, and so what makes her, more attractive? Is it just the cost of living?
So technically, yes, she has no plans, at least on paper, to leave the EU or the euro anymore, because she knows that is exactly why she lost back in 2017, 5 years ago. So no plans like that, because she knows that's not popular. But what she proposes, for example, is to cut VAT taxes on fuel, gas, electricity prices from 20% to 5%. So technically, with the current energy inflation we're seeing, this is appealing to many voters. Other proposals include lowering income taxes for younger people, people under 30. She also wants to encourage employers to give a 10% pay rise to everyone, especially the lowest incomes, by cutting all the payroll taxes for those pay rises. So all these measures to support the disposable income of the French, support the working class, support the blue-collar electorate, is giving her a boost in the polls and causing this gap to narrow between her and Le Pen and Macron.
Caroline, thanks so much. Caroline Cournal there, our reporter in Paris. Don't miss our special coverage also of the first round of the presidential election starting tomorrow. We'll be live in Paris, of course, for the whole show. And then as polls close on Sunday, 7 p.m. UK time, 8 p.m. Paris time, we'll also be live. Smart Conversations continue on Bloomberg Surveillance Early Edition.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon. Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Time to shrink. The Fed lays out plans to reduce its balance sheet by over $1 trillion a year. The U.S. also slaps new penalties on two of Russia's biggest banks and on Putin's daughters. Italy says it would support a ban on gas imports if the EU is united behind it. And stay with Bloomberg Surveillance Early Edition. Up next, we have an exclusive conversation with the Chief Executive of Britain's Financial Conduct Authority, Nikhil Rathi. Send in your questions on IB Plus TV Go. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So, as promised, our interview this morning, the UK's financial regulator has just published a 3-year strategy and annual business plan. It hopes that we'll see the body move faster to protect consumers from financial harm and create targets to oversee the UK's financial markets more assertively and efficiently. Well, we're delighted now to be joined by the UK's Financial Conduct Authority Chief Executive Officer, Nikhil Rathi. Thank you so much for joining us. I know you've also singled out some of the social media platforms on some of the immediate action that they can take, so we'll get to that in a second. But you joined as head in 2020. I mean, this is the middle of the pandemic. You've had to live with Ukraine, with COVID, and of course some of the other things. What's been hardest?
Well, good morning, Francine. You're right. It's been a very, very eventful 18 months in the seat as CEO. We've delivered some big changes coming out of the pandemic, £1 billion of compensation for small businesses, major changes in the insurance market for consumers, and now dealing with a tragic situation in Ukraine as well, supporting the multilateral effort there. This morning, we're setting out our 3-year strategy. We are focusing on 3 things: reducing harm, setting new standards, particularly for consumer protection, and promoting competition and positive change. And the key thing for us is targeting some of the firms that are not meeting basic standards. So we're hiring 80 new people on top of 200 that have joined so far this year to really make sure we sort out standards, also to support those firms that are delivering for consumers. So the idea to focus on these 3 cores is actually, I guess, you measure it correctly, because the metrics are easier to I guess, measure and because you've laid it out more clearly, but also act faster. Absolutely. So today we're setting out the next step in our transformation. It's always hard as a regulator to set out metrics, but we're having a go this morning so that we can be judged and we can be accountable for our delivery. And we have taken steps to change our governance so that our decisions, particularly against firms that are not meeting standards, can be taken faster. And that then reduces the regulatory cost for the best firms in the market as well. How much faster? I know it's a difficult question because it all depends on a case by case, but how fast do you need to be more efficient? Well, we need to be efficient at the gateway. So, for example, we've hired 95 new colleagues there over the last year. 1 in 13 firms used to make it through the gateway. Now it's 1 in... So 1 in 7 firms used to make it through the gateway, now it's 1 in 13, so we've tightened that up quite considerably. We are also taking action, as you mentioned earlier, with respect to social media, where we're seeing scams really escalate, particularly during the pandemic. We've been pleased to see Google adjust their policies so that financial promotions in the UK on Google can only be provided by firms that are authorised by the FCA. And this morning we've pressed Meta and Twitter also to give us clear timetables for action.
And Nicole, these are scams in what space? So is it the crypto space, or is it really just broad-ranging?
It's broad-ranging, a whole range of financial scams, whether it's crypto, payments fraud, high-risk investments. Firms are subject to standards for financial promotions. We want to make sure everyone's meeting those standards. We're particularly concerned that vulnerable consumers can go online and can get duped very quickly out of very substantial portions of their life savings.
How difficult is it to hire the right people, to finding them and actually then attracting them to the organization?
Well, we're really pleased to have had 200 colleagues joining so far this year. We're expanding nationally as well, recruiting in Leeds and Edinburgh, and we're bringing in more diversity of skills, in particular in data and technology. There's been a buoyant labour market in the UK, but we're confident that we can deliver against the targets we've set out.
I mean, technology is extremely difficult because there's, of course, a danger that, some of these are so sophisticated by the time you see what's going on and regulate them, you're too late to the game. So how much, is this one of the most difficult parts that you need to deal with right now?
Absolutely. We need to be ready to move fast and in a more agile way. So we're bringing in more technological expertise. We've also been a world leader, I would say, in supporting fintech innovation. We have a sandbox which has been emulated by a number of our colleague regulators around the world to enable fintech firms to pilot their ideas. We've taken steps to improve our listings regime so that technology firms can raise capital more easily in the United Kingdom. And we're launching this year what we're calling a scale box, so firms can grow faster and meet regulatory obligations at the same time. So innovation is absolutely central to the future vision for the FCA.
Nicole, when you look at, of course, the sanctions in Ukraine, how are you, keeping up with that? Is there an area of concern of how some of these things are either, being put round or how they're being used?
It's a very fast-moving situation, and we are working very closely with governments and our partners around the world to make sure that the financial market is able to adjust to these sanctions and that some of the technical issues that arise are identified and dealt with quickly. We're now pulling together some special teams to monitor compliance with the sanctions across all domains, whether that's in the banking sector, asset management, insurance sector, but also in areas such as crypto, where we have to make sure that there are no new avenues for evading the rules that are in place.
Have you seen that so far at all? So I guess Russian wealth and e-money, and actually how much of concern is that?
There has been speculation that has been happening, and we're watching that very closely. What's really important, I think, is that leaders of these firms, wherever they may sit, are cooperative with the effort here to make sure that the sanctions are effective and have the intended outcome.
And have most firms that you've reached out to, have they been cooperative with the FCA?
Absolutely. I think firms have responded very quickly. I'm also very proud of the team at the FCA who've worked incredibly hard to get these systems in place, and everyone is trying their hardest, I think, to make these as effective as can be in what is a very fast-moving and difficult and sad situation.
Nicole Ratti, thank you so much for joining us today. That was the Chief Executive there of the UK's Financial Conduct Authority joining us for an exclusive conversation this morning. Now, coming up, battle of the boardroom, the power struggle between Italy's largest insurer, richest man and most prominent investment banker continues. We'll discuss what's going on at Generali next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in London. Now, the power struggle between billionaire bankers at Italy's largest insurer, Generali, continues, and it's not dull. On the one side, Italy's top-ranked billionaire, Leonardo Del Vecchio, and businessman Francesco Gaetano Caltagirone, who together amass a 15% stake in Generali. The pair maintain that Generali has fallen behind in asset management and seek to oust the chairman and chief executive. Now, they have promised higher earnings growth, sweeping cuts, and more deals. Opposing them is Italy's most powerful investment banker, the chief executive of Mediobanca, Alberto Nagel, who holds a 17% stake in Generali and stands behind the incumbent chief executive, Philippe Donnet. Well, we're now joined by ex-Goldman Sachs banker and chairman of Milan-based investment banking boutique, CC & Soci, Claudio Costamagna, who Caltagirone and Del Vecchio would like to see taking over the role of chairman at Generali. So I hope that's clear. It's certainly clear to us, but I've been also following the story very closely. Claudio, thank you so much for joining us. I mean, this is a battle like we haven't seen, or we've rarely seen in Italy. First of all, you're here talking to investors because they want them on your side. How's that going?
Well, no, I think it's going well. I mean, first of all, it's not the first time that this thing happens in Italy. In fact, I was involved in the first ever proxy fight on the Milan Stock Exchange, which was back in 2012 with Impregilo, where also we went against the incumbent shareholder, which was backed by Mediobanca, and we won, and we changed completely the profile.
Yeah, this feels big also because they hold so much of the Italian bonds. So it feels like it's a systemic institution almost.
Yeah, no, Generali is much bigger, of course, and it's strategic assets in Italy, that's clear. I think that the reason why Mr. Caltagirone decided to do this is because if you look at the last 20 years, there's been a steady decline of Generali vis-à-vis its peers. Its peers are Allianz, AXA, and Zurich mainly. And if we take the combined market cap of those four insurers, back in 2005, Generali represented 28%. Now it is 14%, so half of it. So clearly there's been a steady decline of the company.
That you say is not necessarily linked to Italian politics or the Italian discount.
No, it's a variety of reasons, I think. One is also the reason that Mediobanca has sort of always kept a grip on this, but it's not the only reason. There's been issues that have never been tackled, really. And that's one of the reasons why we decided to go with Luciano Cirinà, who's been there for 33 years, who's worked at Generali, who runs, or used to run, because now he's been ousted, but he used to run the most profitable region of Generali, in order to start tackling those issues and really try to rebound it and make the gap that in these last 20 years has been created with the peers.
Claudio, you have supporters and you have critics. The critics say, look, you want to cut costs, but where? Actually, the plan's not detailed enough.
I think cutting costs
and
is
you want M&A, which is hard to do.
Yeah. Well, first of all, cutting costs is one of the things, and it's not the most important. I think the most important one is invest in technology and data analytics, which they underinvested up to now. There's not been any convergence of the systems around the various countries, and that's the most important thing that we need to tackle, because the world is changing at an incredibly fast pace, and we need to keep up with that. And investment in technology is the first thing. The second thing is review the geographic footprint. 85% of the profits come from 4 regions, and we are in 20 countries. You know, why? It's managerial complexity, and we need to simplify that.
Simplify and then do M&A.
M&A is the cherry on the cake. Okay.
So there's a lot of talk about M&A in India, emerging markets.
It's really the cherry on the cake. I mean, first we need to have the cake fixed, and then you can put the cherry, if you find the right cherry, of course. And I think that if we find the right cherry in terms of it fits our strategy, and especially on the asset management side, which is another area where Generali is lacking its peers, there I think we should do something.
How many investors are behind you? Do you actually think you can win?
We actually think we can win, absolutely. You said at the beginning that Mediobanca has 17%. In fact, Mediobanca has 12.5% or 13%. The 4% difference is stock that they borrowed in order to vote for the shareholders meeting, which is something which is, you know, a dubious practice, because it is forbidden, for instance, by ISLA, which is the International Securities Lending Association, of which Mediobanca is a part of. Which
but I think so. On the regulatory side, so they have 17% in voting rights. But Claudia, how many investors have said that they will support you and actually go against?
We cannot say the number, but it is substantial.
Do you worry that
there is a large retail portion, which nobody talks about it? You know, the institutional side is relatively small compared to the size of Generali. Also because Generali in the last 20 years has been mainly a macro play on interest rate and on Italy. It doesn't mean an equity story.
But Claudio, I mean, retail, so this is what small investors, do you need to like knock on doors? And do they care?
Absolutely.
If they have a steady return, do they want to do
But there are two kinds of retails.
Yeah.
There is the retail, which is really retail, I mean, 10,000, 20,000 euros. But then there is a retail of large families. And Generali has always been, a sort of secure investments. They always pay the good dividends, and so there are a lot of families which we are knocking at the door. Absolutely.
The current chief executive Generali, I think, said that the dividend is at risk with your plan.
It is absolutely not a risk. In fact, I think in our plan we're going to generate more cash than what
this is a promise? Is this a commitment?
Absolutely, and we said that we're going to keep the dividend the same as the plan of the current management, but we say even something more, that if we cannot find the famous cherry on the cake, we're going to have excess cash, and that excess cash we can easily distribute.
How big is a cherry, though? Is it like a basket of cherries?
I mean, we don't know. I mean, M&A, you need to be two to dance, right? And we don't know yet.
Okay. But you see real opportunities out there.
I think there's going to be opportunities, but we have to get the right one, and which is exactly ancillary to our strategy. If it's not ancillary to our strategy, we're not going to do it.
Claudio, do you worry that actually this is a lose-lose situation, because whoever wins will have a board that's split? And if you're a retail investor, I mean, it feels messy.
No, I think if we win, there's not going to be any changes, because at the end of the day, Mediobanca, it's in Mediobanca's interest to create value as well, because they are the largest shareholder. So if we create value for shareholders, we're going to create value for Mediobanca as well.
Yeah. So you don't think there's foreign investors in saying, Generali right now is something that I don't want to touch because I'm not sure exactly how it falls, and it just feels also quite
It might be, but that's exactly what I think we should do. If we get elected, we're going to have to do a lot of work to try to convince long institutional investors, not passive investors, to invest in Generali, because the potential is absolutely there to really do a great job.
So I know you've also recalled it because there's of course the lion. So this is the regenerating lion, the roaring lion, right?
Absolutely.
Is how you call your plan.
The
awakening lion. There you go. I couldn't find the words. Who do you think your biggest rival that you could mimic is in this insurance space?
Well, those three guys, Allianz, AXA, and Zurich, are the three peers, and we need to look at what they've done. But Generali has its own history, its own DNA, and we need to work on that to make it better, not just look at the others. But clearly, those three are our three main competitors.
Gold standard. Claudio, thank you so much for joining us. Claudio Costamagna, they are the chairman of the Milan-based investment banking boutique CC and Soci. And of course, we have also reached out to Generali, and we'll see whether we can get the leadership of that company on air as well. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The US has announced new sanctions targeting President Putin's adult daughters, along with two of Russia's biggest banks. The Times newspaper, meanwhile, reports the UK is drawing up plans to send armored vehicles to Ukraine, as well as anti-tank and anti-aircraft missiles. Italy said it would support an EU-wide ban on Russian gas if the bloc was united behind that idea. Now the Fed has laid out a long-awaited plan to shrink its balance sheet by more than $1 trillion a year. Minutes from its March meeting also show many officials would have preferred a 50 basis points hike, but held off because of Russia's invasion of Ukraine. The maximum runoff total of $95 billion a month is almost double the peak rate the last time the Fed trimmed its balance sheet in the period from 2017. Now, the UK is ramping up plans to build new nuclear power stations and offshore wind farms as it seeks to shore up energy supply in the wake of Russia's invasion of Ukraine. The government's energy security strategy targets a tripling of installed nuclear power capacity by 2050. It also adds more ambitious targets on hydrogen, solar power, and North Sea oil and gas projects. And New York City has seen major crime rise by more than 36% in March from a year ago. Police say citywide shooting incidents increased by 16%, robberies by 48%, and burglaries by 40%, though homicides did fall. Mayor Eric Adams, who started his campaign on public safety, has focused the first months of his mayoralty on fighting the city's rising crime levels. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Coming up, Bridgewater wins big while some others suffer for brutal reverses. Hedge funds in focus. That's coming up next, and this is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Global infrastructure partners and Brookfield Asset Management say they have made a non-binding bid for Italian infrastructure company Atlantia. This comes after Bloomberg's report that Blackstone is said to be exploring a bid for Atlantia, raising the prospect of a bidding war with Spanish construction tycoon Perez. Now, HP shares surged as much as 10% as a filing showed Berkshire Hathaway bought a stake in the laptop maker valued at more than $4.2 billion. Warren Buffett's company had historically shied away from tech investments, but has leaned into the sector in recent years with a stake in Apple. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now let's focus on the hedge fund industry. And Ray Dalio's Bridgewater posted a 16.3% return in the first quarter, while Glenview Capital's flagship hedge fund rose 5.9%. Tiger Cub suffered a brutal reversal amid 2022's market turmoil, losing money on their favorite trades of tech giants and unicorns. Well, joining us now is our Bloomberg senior reporter covering hedge funds. He knows it all in hedge funds, and he's Nishant Kumar. Nishant, thank you so much for joining us. And before we look at the winners and losers, I mean, you sat down and you kind of said, wow, what a crazy quarter. So who won and who lost?
Yes, I mean, it was a sensational quarter for hedge funds. Whatever they required to make money was there if their bets were on the right side of the volatility that we saw during the first quarter. So the leader of the pack is a macro hedge fund run from New York, Heather Jupiter Fund. That fund was up 148%. You know, that's sensational. He has broken his own record of biggest month twice so far this year, and he's having a dream run, his best year so far. And primarily, we don't exactly know his trades, but it seems what contributed to his massive returns is rates trading and commodities. Of course, commodities benefited hugely and helped a lot of macro funds last quarter because of Russia's invasion of Ukraine.
Yeah. So, Nishant, that's clearly a winning bet. What were some of the losing ones? And again, volatility, it just depends on how you trade it. So what are we expecting going forward?
So it seems the volatility is here to remain. Commodity prices are going up or volatile. Central banks are ending their quantitative easing, which had troubled a lot of hedge funds over the last many years. Interest rates are going up. So all these are really fertile hunting ground for hedge funds if they are on the right side of the trade, obviously. The things that did not work out very well for some hedge funds, and you mentioned Tiger Cubs, was you know, these funds had gained massively because of their bets on technology and growth stocks, and some of the unlisted names as well, unicorns. All those, you know, pockets of the market suffered massively last quarter, and that led to some really significant losses, as much as 1/3 of their assets last quarter.
Nishant, thank you so much. Nishant Kumar there, our star reporter in hedge funds, with a great story looking at Bridgewater, Rocos, and of course some of the others as well. The markets, they're still on the up, not as much as they were before, but certainly markets showing signs of a recovery. Traders stepping in after a sell-off sparked by hawkish minutes from the Federal Reserve. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kay Lyons in New York. Our Guy Johnson is here in London. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done, uses a small sample number, and most of the time, when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is not quite duck and cover territory.
It's all about QT. That's what's driving things.
This is a Fed that's trying to use its policy tools, both rate hikes and the balance sheet.
They'll go for a soft landing, but their chances of pulling off are very, very low.
This is Bloomberg Surveillance, early edition, with Anna Edwards, Matt Miller, and Kayleigh Lines.
10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong on this Thursday, April the 7th. Our top stories today. The Fed's minutes signal an aggressive unwind of its $9 trillion balance sheet and point to a half-point hike at next month's meeting. Ukraine pleads for NATO to send more weapons ahead of an expected Russian offensive. It's also accusing Germany of dragging its feet. We're going to be live at NATO headquarters in Brussels with the latest. And Warren Buffett certainly has his appetite back. Berkshire Hathaway confirming overnight that it's bought a $4.2 billion stake in HP. The laptop and printer maker stock up sharply pre-market. Welcome, everybody, to Bloomberg Surveillance Early Edition. I'm Guy Johnson in London with Matt Miller and Kayleigh Lines in New York. Anna Edwards is off today. Kayleigh, overnight, Asian equities taking a bit of a hit.
Yeah, catching up, or rather maybe catching down to the losses we saw in the U.S. and Europe yesterday. Pretty much down across the board when it comes to the regional benchmarks. The MSCI Asia Pacific Index as a whole fell more than 1%, actually more like 1.4%. One individual stock story I wanted to point to, though, is JD.com. The company's founder and CEO, Richard Liu, stepping down from that CEO role, really joining a long list of big Chinese tech tycoons who have had to exit top management roles due to Beijing's lockdown on that sector, crackdown really from a regulation standpoint. So JD.com was down about 3.2% overnight. In other asset classes, I also wanted to point to the cooling we are seeing in the selling pressure in the global bond market. That was true too in Australia. You had yields coming down, therefore price going up, down about 4 basis points on that 5-year yield, the belly of the curve, right around 2.745%. And then I also wanted to point out in the commodity complex, iron ore lower for a third day in Singapore, down about 3%. The issue there, Matt, is China. Rising COVID cases, lockdowns resulting. That creates a huge demand question, not just for iron ore, but really commodities across the board.
Yeah, and really interesting to look at commodities as well as investors boost their exposure to the sector, to the asset class. Take a look at what's going on here. We have kind of a risk-on picture. S&P futures are up. Of course, we've seen drops in the cash trade for the last couple of sessions of 1% or more. The U.S. 10-year yield right now coming down as investors buy that. So it does show at 256.78. Lower yields may be better for tech stocks, although they haven't reacted too poorly over the last couple of days to high yields, not terribly badly, depending where you look. Longer duration, maybe not as good as shorter duration equities. Crude right now up about 1/3 of 1%. 96.52 is the number for NYMEX crude, so a little bit of a bounce back, but very small. And Bitcoin also down, but only 0.9 of 1%, 43,505. There are not a lot of huge moves in today's market, guys. So at least on this side of the Atlantic, it looks like we're still kind of waiting for something or trying to digest the Fed minutes that we got yesterday.
Absolutely. I think the move came post-Brainard, Lael Brainard, obviously front-running the Fed minutes, so maybe less of a reaction. The market maybe a little bit more attuned to what we were going to get. European equities generally well bid today, but they're coming back only a little bit. London is underperforming. The reason for that, the mining stocks and the oil stocks are actually down. Names like Glencore and Shell. I'll show you Shell in just a moment. But broadly elsewhere, actually some fairly decent pictures emerging. Let's talk about some of the individual assets that we want to be focusing on and get some details there. So the stock 600 up by 0.7 of 1%. I mentioned Shell down by 1.7%. Commodities broadly are lower today, but Shell confirming it's going to take a $5 billion hit as it exits from Russia. The French 10-year, pay attention to what is happening here today, catching a bid, but we're warming up to this weekend's elections as the polls continue to narrow. The second round looks like Emmanuel Macron and Marine Le Pen. The market's starting to pay attention there. And euro-dollar, the dollar is actually continuing to be on the front foot. That is a takeaway from the Fed minutes. We've now got a 108 handle on euro-dollar. We're waiting for ECB accounts. They come out at lunchtime, Europe time. Let's have a quick check on what is happening with Russian assets. We've been focusing on what's been happening with the ruble over the last few days. Dollar ruble now at 79. Remember, it was up at 140. We've completely round-tripped. Is that a real market? The concern here ultimately is that as Europe continues to buy gas from Russia, it continues to support the economy and continues to support the currency. U.S. officials certainly paying a great deal of attention to that one, Kayleigh.
Absolutely, Guy, and we're going to have more on that story in just a minute. First, though, I do want to mention some breaking news out of the auto sector. Mercedes-Benz in the first quarter saw car unit sales down 15% from January to March. That was due to challenging market conditions, mainly due to semiconductor bottlenecks. Of course, this is a story we've been hearing for some time. On the better news, though, Mercedes-Benz EV sales in particular tripled. So that is looking, the electric strategy is looking like the real growth driver going forward. Now, let's look ahead to what else is coming up today. As Guy mentioned, the ECB will publish its account of its March policy meeting at 7:30 a.m. New York time. Also, the United Nations General Assembly is set to vote on whether to suspend Russia from the Human Rights Council. That is a move that the United States in particular has been pushing for. Then Fed speak will continue. Can we even get any more hawkish? James Bullard, Raphael Bostic, and Charles Evans all will be speaking throughout the day. Also speaking today, Peter Thiel, Kathy Wood, and Michael Saylor. They're all set to speak at the Bitcoin conference, B conference in Miami. And finally, Matt, this one's for you. The Masters Golf Tournament kicks off in Augusta, Georgia with a green jacket and $11.5 million on the line. And as of right now, Tiger Woods will be playing, Matt.
Yeah, absolutely. I know what I'll be doing this weekend for sure. And it won't be paying attention to the Fed. But there has been a lot of Fed going on, and there's a lot more to come. Fed officials have laid out a roadmap for reducing the assets they bought during the pandemic. They plan to shrink their balance sheet by more than $1 trillion a year at the top end. That's according to the minutes of their meeting in March. Bloomberg's Danny Berger joins us with more. Danny?
Matt, I think Guy put it really well when he said that Brainard front run a lot of this meeting's notes. No real hawkish surprise. Of course, we did get more details. Details always important. That max cap of $95 billion of selling, unwinding of the balance sheet a month. So in terms of a market reaction, it wasn't one of surprise. It was one of continuing trends. Let me run us through those trends. One was of a strengthening greenback, dollar flirting with its highest since 2017, rather. The other one we've been witnessing is this rise in mortgage bond yields. 30-year yield, the benchmark of Fannie Mae paper. I have a chart for that for our radio listening audience. That one has also been spiking up higher. Now it's the highest in about a decade, save for the period in 2018 when we first got QT. The upset in the market, that caused the Fed to back off. Now, one of the final ones we also saw in reaction yesterday was this rise in real yields. 10-year real yield just 20 basis points away at one point from hitting a positive level. Now, with those real yields coming up, you also duly saw equity markets react to a bit of a sell-off, especially in the longer duration tech stocks. Now the question is, how much damage will the Fed allow? Of course, if you're Bill Dudley, you think wealth destruction is a feature, not a bug of monetary policy. And Guy, of course, I should mention, within the shadow of all of this, we also get ECB minutes out later today.
Absolutely. They get very upset when you call them minutes. You have to call them accounts. Absolutely. They have to differentiate themselves from the Fed. Danny, great stuff. Thank you very much indeed. Bloomberg's Danny Berger on what we got from the Fed last night and what we're going to get from the ECB a little bit later on. Let's return to the situation in Ukraine. The country's foreign minister pleading for more weapons at a meeting of NATO allies in Brussels.
My agenda is very simple. It has only 3 items on it. It's weapons, weapons, and weapons. We are confident that the best way to help Ukraine now is to provide it with all necessary to contain Putin and to defeat Russian army in Ukraine, in the territory of Ukraine.
Continue our global coverage of what is happening in Ukraine with Maria Tadeo, our Europe correspondent. She's at the NATO headquarters in Brussels. Jack Fitzpatrick, Bloomberg government reporter, joins us now from Washington, D.C. as well. Maria, let me start with you. The NATO Secretary General is warning that we are entering, quote, a crucial phase in this war. The Ukrainians want more weapons. How will NATO allies respond?
Well, Guy, the Secretary General was very clear this morning. He says Russian troops at this point, they're just taking a break before a major offensive in the east of Ukraine. They're regrouping to resupply and rearm. That was his words earlier today. He also says that the goal here is potentially to take the entire Donbass region. Remember, this is geographically very important for Vladimir Putin. We've talked about this for weeks, this push for the Russians to create a land corridor between the Donbass, Mariupol, and then, of course, Crimea. The other big thing here, of course, is that Vladimir Putin is facing the clock. Remember, there is this big parade coming up on May 9th. This is Victory Day for the Russians. It's the big Soviet Union defeat of Nazi Germany. Vladimir Putin needs to show his public something for this war. Now, when it comes to NATO ministers, it's very clear they don't want to get involved in this. They say we are going to, however, continue to support Ukraine with weapons. But we heard also from the Ukrainian foreign minister who says that is not enough. NATO continues to make a distinction between offensive and defensive. He says at this point, all of Ukraine is defending itself and therefore needs heavy weapons, all kinds of weapons. And by the way, guys, just as some color, outside of NATO today, there was a protest of Ukrainians who were fighting and, well, again, screaming on a megaphone saying fighter jets for Ukraine, fighter jets for Ukraine. So that gives you a sense of the mood here in this meeting.
All right, Maria, thanks very much. Maria Tadeo there at the NATO headquarters in Brussels. Now, in Washington, President Biden says U.S. sanctions are crushing Russia's economy.
Just in 1 year, our sanctions are likely to wipe out the last 15 years of Russia's economic gains. And because we've cut Russia off from importing technologies like semiconductors and encryption security and critical components of quantum technology that they need to compete in the 21st century, we're going to stifle Russia's ability and its economy to grow for years to come.
Let's get to Jack Fitzpatrick. He is in Washington, D.C. to talk about what the U.S. Wants to do in terms of sanctions and how the U.S. can influence also those who are helping Russia. At least India, for example, continues to buy oil from Russia.
Yeah, obviously there's been a lot of focus on President Biden's conversations with European allies trying to have a unified front on sanctions there. But there has been a little bit more pressure on India lately. Just yesterday, White House Press Secretary Jen Psaki said it had been communicated to India that it would be a bad idea for them to have any more of a formal relationship and accelerate purchases of Russian commodities. Worth keeping in mind also that in addition to energy commodities, Russia is, or rather India is the largest purchaser of Russian weapons. So any tensions with China or Pakistan actually sort of indirectly plays into that dynamic that ties them economically to Russia as well.
Well, Jack, of course, the U.S. hasn't just warned India about helping Russia. It's warned China as well. And that relationship maybe could get just a little bit more testy after news reports overnight that Nancy Pelosi, the House Speaker, is going to visit Taiwan this weekend. How significant is that?
That would be very significant. The Speaker's office has not confirmed that. They play these congressional delegations very close to the chest, but the reporting from the Fuji News Network is that she plans to go there this weekend and would arrive on Sunday. This would be the first time a speaker has visited Taiwan since Newt Gingrich in 1997. It has already gotten a bit of pushback from China. A spokesman for the Chinese Foreign Ministry said there would be consequences. They would take strong measures that they haven't detailed, but take strong measures against the U.S. So clearly it would be a major sign toward Taiwan and something that is not being taken lightly by China either.
All right, Jack Fitzpatrick of Bloomberg Government down in Washington, D.C. for us this morning. Thank you so much. So that's what's going on in political news. Let's talk about corporate news now. Warren Buffett's Berkshire Hathaway has taken a stake in laptop maker HP, valued at more than $4.2 billion. Now, Berkshire has traditionally stayed away from some of those technology investments, but it has moved into that sector in recent years and now owns about 121 million shares of HP. As a result, that stock getting a huge lift in pre-market trading, up about 11.7%. before the bell. Another stock moving to the upside is Roblox, the video game company. It was initiated with a buy over at Citi, $59 price target. The stock trading at $46.40 right now, up a little more than 1% in early hours. To the downside, though, SoFi is moving lower. This, of course, is a lending company. Part of its business is refinancing student loans. It had to cut its forecast because of the Biden administration's move to pause student loan payments for even further out into this year. That stock is down about 5.5% in early hours as a result, Guy.
Kelly, we were mentioning the ECB, but just a moment ago, we have news from Frankfurt, from the ECB. President Lagarde has COVID. Now, she's saying at the moment, or at least the ECB is saying at the moment, that the symptoms are, quote, reasonably mild and will have no impact on ECB operations. The ECB is now in a quiet period ahead of its meeting next Thursday. The Governing Council meeting is in person. The press conference is virtual. So one would have to assume that Christine Lagarde will not be at that Governing Council meeting, and it comes at an interesting time, as obviously we have a growing number of hawks increasingly worried about the inflation data that is coming out of the Eurozone. Talking of inflation data, talking of the fight against inflation, we'll be referencing that next. Stephen Blitz, Chief US Economist at TS Lombard, will be joining us to focus on the Fed Minute. We're going to speak to an expert in multilateral sanctions. Dr. Clara Portela from the University of Valencia is going to be joining us, plus the return of the Bloomberg Wealth Summit. Highlights include Ares Management, Michael Arrighetti, New York Stock Exchange Group President Lynn Martin. It all starts today at 9 a.m. in New York, 2 p.m. in London. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
The war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and Bloomberg Television. I'm Matt Miller here in New York with Kayleigh Lyons. Guy Johnson is in London. Anna Edwards is off this week. I'm looking at something that happened yesterday, but after my bedtime, I guess, around 6 a.m. Bill Dudley calling for the Fed to force equity corrections or really reduce or destroy wealth, as if it's a feature, not a bug of Fed policy. I thought that was really interesting. And this chart that I'm showing for those of you listening on radio is U.S. financial conditions. Obviously, we've tightened a bit, but we haven't seen a huge drop in equity levels. S&P index in the bottom panel here. Tatiana Dari of Bloomberg M Live joins us right now. And Tatiana, I wonder how people react to this, because I just think it's pretty shocking to hear, although it makes sense logically that that would happen since we created wealth on the upside.
Yes, exactly, Matt. As you said there, Bill Dudley coming out with that op-ed piece saying that stocks and bonds will have to suffer more. And as you pointed on that chart, we haven't tightened that much. And actually, if you zoom into 2022, you'll see there's a green bar for the month of March. And that's because stocks have rallied, and that has filtered through to other asset classes like credit and junk bonds in particular. So the Fed needs to tighten a lot more. And if the tightening, according to the latest minutes, and if the tightening doesn't happen on its own, as Bill Dudley said, then the Fed will have to shock markets here by sending stocks and bonds lower.
Tatiana, when I talk to equity investors, the thing they talk about is what's happening with real yields. Real yields have really benefited stocks because they've been negative for quite some time. They're starting to creep out back up to zero. My question to you is, do we need to get to zero for stock markets to react, or do we need to go north of zero for stock markets to react?
I think we're seeing some reaction in stocks already. Yesterday, a big sell-off there, but today we're seeing stocks in defensive mode. And obviously, as though those yields are rising, and if we hit positive territory, then all of a sudden they look good, and all of a sudden there is somewhat of an alternative to stocks. So then the relative value of stocks becomes a little less attractive, especially for the highly priced technology shares. And we've seen tech leading the sell-off here this week. But of course, we'll see where it goes as traders are still in pricing discovery mode.
Tatiana, in the last few days, we've seen the yield curve here in the U.S. steepen back out. Once again, the 10-year Treasury about 13 basis points above that of the 2-year. Is there any sign that that's sustainable, or is reversion to inversion more likely?
Well, it depends on, again, on those Fed expectations and where inflation goes from here. But for those that are concerned that yield curves signal a chance of recession, we have looked at what this does to the stock market and actually showed that stocks have largely posted more gains than losses when yield curves inverted. But I have to say, looking at how it's been performing, it's not unusual for the curve to invert again after a few brief positive sessions.
Tatiana, we're going to leave it there. Thank you very much indeed. Tatiana Dari of Bloomberg M Live, Market Live. Thank you very much indeed. And for more of that excellent market analysis, all you've got to do, go to your terminal, MLIV Go, on the Bloomberg. You'll find what you're looking at here on the screen, some excellent analysis. This is Bloomberg.
worries about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Guy Johnson in London. Now keeping you up to date with news from around the world, here's the first word. In Ukraine's port city of Mariupol, the mayor says that Russian attacks have killed more than 5,000 civilians. He also says that more than 90% of the city's infrastructure has been destroyed. If Russia captures Mariupol, it would open a land corridor to the Crimean Peninsula, which of course Moscow seized from Ukraine in 2014. The next economic jolt to Russia will probably come in the labor market. According to a Bloomberg survey of analysts, unemployment there this year is set to more than double, exceeding 9% for the first time in more than a decade. Sanctions have put pressure on the Russian economy and are having it on course for one of the deepest recessions in Russia's modern history. And a copy of the first ever tweet by Twitter co-founder Jack Dorsey has been offered for almost $48 million on non-fungible token marketplace OpenSea. That's 16 times what the owner paid for it a year ago. The owner is the CEO of a Malaysian blockchain company. He's offered to give 50% of the proceeds from the sale to charity. Coming up, we'll get away from NFTs and back to the markets and back to the U.S. economy and get reaction to the Federal Reserve minutes from Stephen Blitz, chief U.S. economist at TS Lombard. Have we reached peak hawkishness? This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition, and here's what you need to know. The Fed minutes signal an aggressive unwind of its $9 trillion balance sheet and point to a half-point hike at next month's meeting. Ukraine is pleading for NATO to send more weapons ahead of an expected Russian offensive. It's also accusing Germany of dragging its feet. And Warren Buffett certainly has his appetite back. Berkshire Hathaway confirming overnight that it's bought a $4.2 billion stake in HP. The laptop and printer maker's stock is up sharply pre-market. So I'm Guy Johnson in London. Matt Miller and Kaylee Lyons are both over in New York. Anna Edwards is off today. Matt, what's going on pre-market?
You know, there's not a heck of a lot going on. I think you said it really well at the top of the program that Lyle Brainerd really was front-running the Fed minutes. And we got our reaction yesterday and actually the day before in the drops that we saw. We do see futures up now, almost 0.2%, but not a huge move to the upside. And investors are buying bonds as well. That pushes the yield down to 2.5715. NYMEX crude up about 1%, a little bit more right now. So recovering from the drops that we've seen, the big drops that we've seen over the last couple of sessions. 97.39 is a level there, holding under 100, and Bitcoin holds under 45,000, even as this big conference goes on with the amazing new bull unveiled yesterday in Miami. Bitcoin down 1.25% to 43,337. Kaylee, what are you seeing in terms of pre-market movers?
Well, the one big story we are watching is HP. Warren Buffett's Berkshire Hathaway taking a $4.2 billion stake in the company, equivalent to about 121 million shares. Kind of an unusual move for Berkshire that usually has stayed away from technology, but is increasingly dipping its toe into it. And HP is reaping the reward of that stock up about 13% in early hours. Something else I noticed in the pre-market trade that I thought was kind of interesting is you're seeing a lift really across the board for EV makers in particular. Of course, this group of stocks has been weighed down a bit by supply chain challenges, fears around sanctions put on Russia, making that potentially worse. But they're getting a nice reprieve today. You have Rivian, Lucid, and Tesla all up between 1.4%, 1.7% in early hours this morning, Guy.
Kelly, here in Europe, stocks are definitely bid. You've got them up by around 0.6%. I don't think it's that big a move, though. We have seen a few down days. This doesn't feel that convincing, but we are trading higher. Commodity stocks, though, are lower. It's the metal stocks, it's the mining stocks, it's also the oil stocks, names like Shell and BP. Shell confirming that it is going to take a circa $5 billion hit as it exits Russia. That's certainly what it's flagging. Keep an eye on what's happening with European bonds. They are bid today, so yields are coming lower, but they have been shooting higher over the last few days. In particular, keep an eye on the OAT, the French 10-year. This as we track towards this weekend's election, first round. Got to keep an eye on that one. Marine Le Pen, Emmanuel Macron, really getting close in terms of their polling numbers. And the dollar just goes from strength to strength right now. We've now got euro dollar trading at 108.78, below 109. We've moved progressively down over the last few days. That's going to be a problem for the ECB as we watch what is happening here in terms of the imported inflation story. They're going to keep an eye on that. Now, it's not going to have a big impact in terms of trade, but it is another factor in terms of that inflation narrative as energy shoots through the roof. Talking of what is happening there with the energy story, let's focus on what is happening with Russia, particularly what's happening with the ruble, which is now completely round-tripped. Got up to around 140 as the initial invasion impact was felt, but has completely come back down again. Is that a free-floating currency? Maybe not, but we're trading 79 right now. The optics are that Russia is weathering that, and that's something you want to pay attention to as well. Keep an eye on the 10-year bond. Clearly, the message coming out of Washington from the Treasury is they are pushing for a default by Russia, Kayleigh, and that's certainly what we're watching. And the Russians are going to be continuing to push back on this narrative.
Absolutely, and they're doing so right now. We're hearing from Dmitry Peskov, who, of course, is the Kremlin spokesman. He's speaking on a conference call. He says that Russia will respond to the latest round of U.S. sanctions, that Russia is continuing work in the G20 mulling summit plans. And this is interesting because, of course, that G20 happening a few months from now in Bali, it's been a question mark whether or not Vladimir Putin will attend and what that means for participation from the likes of the U.S. The Kremlin also saying that U.S. arms supplies to Kyiv are a negative for peace talks. This, of course, as Ukraine continues to call for more weapons from NATO. And Dmitry Peskov also saying that Vladimir Putin will hold his regular Security Council meeting today, Thursday. So we'll continue to monitor those headlines. Meanwhile, on the economic front, the Fed signaling its most aggressive efforts in decades to curb inflation. Officials will begin selling off that $9 trillion asset portfolio, starting to run off that balance sheet, and may raise rates a 0.5 percentage point next month. Joining us now is Stephen Blitz, chief U.S. economist at TS Lombard. Stephen, is this as hawkish as the Fed can get?
Well, no. I think, in fact, it really depends upon how you view the coming quarter, the quarter that we're in, because this will really sort of tell the tale of the tape. There's a lot of reasons to expect this economy to slow down in the current quarter. It's going to be 1.5% growth in Q1 and maybe probably another 1.5% in Q2. So does a growth scare come through, right? So the way to think of it is that the Fed, they said they want to get to neutral. Well, as rapidly as possible. Well, neutral can come to them by the economy coming down. But if the economy does not slow enough in the coming quarter, then they're going to be chasing, and they're going to be chasing for another probably 18 months or so, and rates will get a lot higher than the market is currently anticipating. So it's the economy is going to determine it, and they're just going to follow.
Steve, we had a survey, our MLive blog asked 525 participants if they thought a recession was going to come this year, next year, 2023 or 2024. About half of the respondents said in 2023 is when we're going to get a recession. And in fact, Roberto Perli from Piper Sandler the other day was showing what happens whenever the Fed raises rates to neutral or through, his idea of his estimate of what neutral rates were. We see a recession. Do you expect one?
Well, I always expect a recession at some point. Right. And to say what's going to happen in 23 or 24, I'm not sure what anyone's really saying. I think the important thing for the markets, to understand is that either the economy really slows down enough to take this pressure off the Fed and pressure off of prices near term. And if that fails to happen, if I look back to, say, the late 70s, and I don't expect inflation rates to get anywhere close to that, but it turns out to be very stubborn. And the Fed has to get real aggressive on getting real rates higher. And to date, they're not doing that. And you can still borrow, commercial paper to finance inventory at less than the rate of inflation, at less than nominal GDP growth. And as long as you can do that, you're not going to force an inventory change. And the same is true on the 10-year. As long as you have negative real yields, if you go back to 2018, real yields had to get up at the 10-year, had to get up to about 100 basis points, over 100 basis points, before you really started to see the slowdown in the equity market, and it caused the Fed to reverse. We're a long way from there.
And inflation, of course, getting inflation under control is the main goal of all of this. Yesterday, Bill Dudley said the Fed needs to inflict more losses on investors, as if that's almost part of the program, a feature, not a bug, as people have been saying today. Do you agree?
Well, yeah, because what he's not telling you is that since 2008, we've lived in an asset cycle, not a credit cycle. So the idea of just sort of saying, well, you know, Fed's got to raise rates, it's too expensive to borrow and all that. And that's true, obviously, in the housing market. But broadly speaking, it's not a leveraged economy. So there's two avenues where the Fed can really hurt growth. One at the short end has to do with the dollar, has to do with short-term financing. At the long end, it has to do with the equity market. And if you don't crack the equity market, you're not going to get a slowdown in growth. And you know, at these levels of yields, that in fact is why the equity market is kind of hanging in here right now, because it's looking at what the Fed's doing, it's looking at these balance sheet changes, and to be honest, it's not particularly aggressive.
Steve, let's talk a little bit about the inflation trajectory here. Mechanically, inflation probably is going to fall in the latter part of this year. My question to you is, what does it come down to? I don't think many people expect it to come back down to target, i.e. 2%, but where do you think it settles?
Well, I've been saying actually long before this that it's a 2.5%, 3% inflation rate is probably the right number for this cycle. And I think that if they can get this number under 3%, they'll declare victory. And I actually expect, as the inflation rate starts to fall off, even in the second quarter, in the beginning of the third quarter, that at Jackson Hole, he's going to talk about a 2.5% of the 2% cycle, which is another way of saying the Fed is not going to tighten to the extent that they want to drive inflation back to 2%. If it gets under 3 and it's stable under 3, they'll declare victory and go home.
Declare victory and go home, if only. Stephen, great stuff. Thank you very much indeed. Stephen Blitz, Chief U.S. Economist at T.S. Lombard. Coming up, we're going to speak to an expert in multilateral sanctions. Dr. Clara Portela from the University of Valencia is going to be joining us next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Ukraine is fighting in the defensive war.
we need both the support with weapons, but also to step up sanctions, and therefore I also welcome the fact that NATO allies are now in the process of stepping up further sanctions on Russia.
That was, of course, the NATO Secretary-General Jens Stoltenberg speaking earlier at the NATO meeting, which is taking place in Brussels. Talking about weapons, at the moment the West is largely using sanctions as the primary weapon, the primary tool to try and deter Vladimir Putin from further action in Ukraine. Are those sanctions working? Ultimately, are we heading along a spectrum here where ultimately we are going to have to deal with military options? Let's talk to a sanctions expert about where we are on that continuum. Clara Portela, political science lecturer at the University of Valencia, joining us now. Clara, the debate is starting about what comes next. Where are we in terms of the effectiveness of the sanctions that have been applied thus far? Sanctions take time to work. Are the sanctions that have been used thus far working?
Well, in order to answer this question, we first need to establish what is it that we expect sanctions to accomplish. So if the intention is to mitigate the conflict or to put an end to the military operations in Ukraine, the answer is that they are not working and they are not likely to work anytime soon. But at the same time, there might be other objectives that the sanctions are pursuing, and one of them seems to be to provide a disincentive for the elites that support the current leadership in Russia to continue providing that support. So if the intention is to sever this link, this support that the elites are giving to the current leadership, then we might actually be witnessing some successes, in the sense that step by step, gradually, these elites might be withdrawing the support that is necessary for the permanence in power of the leadership and for the continuation of the military operations in Ukraine.
Okay, well, of course, the one sanctions we haven't seen yet are on Russian gas from Europe, because Europe is heavily reliant on that from an economic standpoint. But Russia heavily reliant on that as a revenue source as well. Could it actually make a difference militarily in terms of the funding of this massive war effort on the part of Russia?
Certainly, it can make a difference. The only difficulty here is that the effect will not be felt overnight. So even if all exports would be stopped overnight, this would not have necessarily an immediate effect on military operations. So the problem here is one of the mismatch between the tool that is being employed and the sort of action that is that is being addressed. Sanctions are a slow tool. Military action is very fast.
I mean, you also have to ask yourself, is it morally tenable? Even if it's going to take time, right? How can Berlin justify sending billions of dollars to Moscow if Vladimir Putin turns around and allegedly commits war crimes in Ukraine? I mean, they should have been asking themselves this since Crimea or possibly before, but now it's especially clear that what they're doing is going to put them on the wrong side of history once again.
Well, I think that the moral case has already been clearly established. So there would be a lot of support from the entire political spectrum in order to stop that energy link. But the problem is that energy links cannot be severed, or energy dependence cannot be reversed from one day to the next. So this is a process that takes time. Meanwhile, the big question is how the economy can continue to cover its energy needs if energy supplies stop overnight, or if suddenly energy prices go up spectacularly from one day to the next. I mean, actually in Spain, we are having a pretty difficult situation at the moment because energy prices have been going up over the past few months, and this had nothing to do with the crisis. But I mean, there has already been a strike going on. So popular discontent, big industry discontent is guaranteed if we experience any abrupt change in terms of energy prices.
Sanctions do have an impact domestically, and the first thing you learn, I remember Sanctions 101 being told that they are often more applied to serving a domestic purpose rather than a foreign policy purpose. Is there an element of what is happening here in Europe that they know, the political leaders, that things are going to get worse in Ukraine? And if you roll out the sanctions kind of all at once, you leave nothing left. And what is left potentially could be military options. So you roll them out more slowly to serve that domestic narrative, that domestic desire to see something done. But if you do it all at once, you don't have that.
Certainly, there is an element of strategizing when it comes to the rolling out of sanctions. And the idea is to go step by step for several reasons. One of them is that you want to give some space for the interlocutor or for the target of sanctions to, mitigate or to change policies. If you do not leave that space, the targets lack any incentive to actually change strategy. If everything is lost for them from moment zero, then what incentive, what reason would they have to try to accommodate the demands of the sender? And it is true that part of the reason why sanctions are imposed is because the domestic audience wants to see some reaction. But the domestic audience is not the only target or the only addressee of the sanctions. Another audience is is Ukraine, the leadership in Ukraine and the population in Ukraine, which wants to see some support from the EU. Another target are the elites in Russia that are receiving the message that they have to stop support for the current leadership because the current leadership is not going to be able to guarantee their prosperity long term.
Clara, we're going to leave it there. Thank you very much indeed for your time and your analysis. Clara Portela, political science lecturer at the University of Valencia. Thank you very much. Now, coming up on Balance of Power a little bit later on, the former UK Foreign Secretary, David Miliband. That conversation, 12:30 p.m. in New York, 5:30 p.m. here in London. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance, the early edition, not to be confused with Bloomberg Surveillance, the OG. We have the creator in our midst here, Guy and Kaylee. Tom Keene joins us with, what? You've got your single best chart you're going to share with us and then tell us about your guest.
Yeah, when I started the show, I tried to get Tyler, the creator, to do the music, and that didn't work out. Let's go to the chart right now. This is inflation, folks, and it's not runaway, but it's getting there. The reason I know is my car coming in today, the Bentley mat is still in the garage. My Uber ride went up $12 in one day, and that's got to be gasoline. That's got to be the inflation we're all living. This is the five-year forward. This is what Tony Crescenzi at PIMCO pays attention to, and all you need to know, we're getting back near the 3% level when we look out 5 years, and then the guesstimate of inflation 5 years from there. We're getting back up near 3%.
Tom, you and I were joking in the break how good the French are now at rugby, which is annoying me a lot, but the focus firmly on politics now when it comes to France. Olivier Blanchard is a professor. He's a professor of economics. He's also French. You've got him on the show a little bit later on. What are you guys going to talk about?
He's the French giant, and what's so important there, Guy, is back when you and I are on the River Seine watching Mr. Macron be anointed, it's real simple. Olivier Blanchard and Adam Posen were talking about a need for a higher inflation. And the key question with Professor Blanchard is, from these levels we're at now, do we come back down to a Blanchard-Posen level of inflation, or are we supposed to dream of getting back to 2%?
All right, Tom Keene, the OG, the creator, anchor of Bloomberg Surveillance. Thank you so much for joining us. Now, other than watching Tom Keene and John and Lisa in a few minutes, here's what else we're watching today. I will be paying attention to, yes, more Fed speak. First, you have Jim Bullard speaking at 9 a.m., the St. Louis Fed president, probably the most hawkish of them all. Then at 2 p.m., you have Atlanta Fed President Raphael Bostic and Chicago Fed President Charles Evans. What can they say, Matt, that the market doesn't already know? We know about the rapid unwind of the balance sheet, and we know about a 50 basis point move in May.
Yeah, I mean, I suppose they'll probably be giving us more detail, and it'll be especially interesting to hear that from Bullard the Hawk. I'm watching the Bitcoin Bowl unveiled yesterday in Miami. The conference continues, Bitcoin 2022. It's really one of the main events for crypto investors. And Kaylee, you and I have a show that focuses on crypto every Tuesday at 1, but of course we pay attention the rest of the week as well. Really interesting amidst this conference to see the price fall down back below $45,000. So we'll be paying special attention to what we hear today.
Something physical at a Bitcoin conference. Shouldn't it be virtual? Anyway, I joke. Boris Johnson is going to meet President Duda of Poland today in London. He's going to meet Olaf Scholz tomorrow. You want to pay attention to that. Hawks and doves. It's going to be a fascinating conversation between all of those. Early edition is done. Tom, John, and Lisa are up next. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Inflation is the driver of the Fed's new, more hawkish position.
We do think the recession consideration goes up if the market does not think inflation will roll back.
It's all about QT. That's what's driving things.
This is a Fed that's trying to use its policy tools, both rate hikes and the balance sheet, to tighten financial conditions.
They'll go for a soft landing, but their chances of pulling off are very, very low.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures up 1/3 of 1%. TK getting ready for some monster balance sheet reduction.
Well, balance sheet reduction, there it is. There's the statistic. Is this a choreographed ballet or what? I mean, do you think Brainerd's comments were orchestrated directly with Chairman Powell? Come on, yes.
And Bank of America say this, Tom. 3 50 basis point hikes in a row, 25 basis points at each meeting thereafter, taking the Fed funds to 325 to 350, just like that.
I would call that a more middle tendency versus what Citigroup is saying, and we can parse the parlor game like that. But that seems to take into account, John, that every step you take has a greater effect. This is the nonlinearness of all this. And to have Olivier Blanchard on with us today is a great and perfect pleasure.
Tom, it's not just the market we've got to talk about. Some foreign ministers meeting in Brussels today, a NATO meeting. Looking forward to catching up with Maria Tadeo on this comment from Ukraine's foreign minister, who said, I have 3 items on my agenda today: weapons, weapons, weapons.
And this is in eastern Ukraine, where there's a real feeling here in the zeitgeist this morning, folks, if you're not following, that Russia's getting ready for a greater war or a renewed and war effort. John, I would not just mention the ministers in Brussels. I would mention the people of France this weekend, Sunday, in this election. Jordan Rochester just comes out and reaffirms weak euro, Le Pen doing better than 2007. And John, you get a 105 euro, according to Jordan Rochester, if Le Pen comes up with a win.
I just read the same note, Tom, coming to where, Lisa, it reads like this. A Le Pen victory might lead to EU tensions, a lower euro, higher uncertainty, but less breakup risk than it could have been back in 2017.
So maybe that's the silver lining. It doesn't exactly give people a vote of confidence. My big question heading into the ECB meeting later on this month is really how much they try to support the euro, how much they talk about giving some sort of boost versus combating inflation, and how much they're actually worried about the economic trajectory in light of tightening sanctions, John.
Did you see what Prime Minister Mario Draghi had to say? What do you want? What do you want, peace or air conditioning this summer?
Isn't he, he's refreshing, right?
You know, hold on a second. Yes, he's refreshing on one hand. He's saying he's for the potential embargo or banning of oil and gas from Russia. as long as everyone else gets on board. And no one else is on board, so it's a pretty easy place to say, sure, I'm on board with that.
Well, the one big country that's not on board is the country that everyone wants to see come on board, and Germany is not boarding anytime soon. Futures this morning, and good morning to you, up 1/3 of 1% on the S&P. On the Nasdaq 100, up 0.5 of 1%. Just to fold things in through the bond market just a little bit, yields in now by a couple of basis points to 257.52. Things calmed down a little bit. We're really light on data this week. A little bit later this morning, initial jobless claims. Then really, the stage set for CPI next week. TK, the estimate at the moment in our survey, 8.4%.
Yeah, I can make jokes about it, but this is really serious. And John, I'm sorry, we're beginning to see the micro effect everywhere in everyone's live, listening and hearing. John, I read the minutes last night. Well,
no, you didn't.
John, in England, do they have the Cliff Notes? Do you have little yellow and black books that got you through college?
I think we used to, Tom. College has changed since my day and yours.
You know, Michelle Smith down at the Fed comes out with the minutes Cliff Notes. I read them last night. It was great.
It's a great start to this program, Tom. Lisa, save us, crude, 97.
Look, and the color's
41.
yellow on radio. I got honestly, my yellow and black cop.
I can't save you because at 7:30 a.m. we get what I would have called the meeting minutes from the last ECB monetary policy meeting, which was March 11th. But I was told coming into this that I cannot call them that. It is the account, because John said we cannot call them meeting minutes.
I mean, you can call them what you want. I mean,
what's the difference?
Tom and I have got in so much trouble with the ECB over the years. We'll give them this one. We just call it the accounts. It's what they want to call them. It's the account of the meeting.
Well, the account will give us a sense of how much the market is edified in bringing forward potential rate hikes at a time when the 2-year German yield has done a lot of the work already. We saw a brief foray into positive territory. Oh my goodness, now just down about 0.25%. How much do you get a sense of going forward, the ECB ready to move to support the euro? And I talk about that with the euro near the lowest levels going back to 2020 if you look at it versus the dollar. Is this a concerning point for the ECB, or do they think it's actually a good thing that could actually potentially increase exports and economic activity? Today we get a slew of Fed speak because it is another day in the week. It includes St. Louis Fed President James Bullard at 9 a.m.
Hello traders, how are you doing today? I'm going to place an order to buy euro. The price I'm looking to buy, 108.92. Okay, order placed to buy at 108.92, just right here. So stay with me. If you want to trade with me, place your order to buy at this level and follow me, follow my trade. Okay, and we will close this trade as always in profit. Okay, guys, I'll speak to you later.
Hey, Lisa, thank you. Busy morning ahead. Let's get the market conversation started with Greg Bowdle, the head of US equity and derivatives strategy at BNP Paribas. Greg, walk me through the update now, because you got long, got bullish at about 4,200 on the S&P. We've gone up, what, 200 points since then and started to dance around the 4,400 mark. Where are you now?
Yeah, good morning, John. So we had this more contrarian bullish view down at the lows, and our call really was that we thought short term we could see the market head into a 4,400, 4,600 range, which is kind of really where we are now. We felt the street had got too cautious, particularly around the US, where we see this picture of relative resilience. So we think we could see a little bit more of a range-bound market in the very short term, but really it's going to be earnings season next week that is really going to be the key catalyst and set the direction for the market through the balance of the month.
Where are people positioned right now? Where is the street bet that I can go against?
Well, we think that the positioning really from the institutional picture looks incredibly clean. So one of the things that we've seen at the start of this year is a real pickup in the demand for hedges. If you look at index put volume, it's been running in Q1 around 30% higher than it has been last year. So there's been a real pickup in hedging activity. And we've also seen institutions take delta off the table. So we track the CFTC buy-side positioning in the S&P futures, and we've seen almost $100 billion of dollars of outflows this year from asset managers and hedge funds, and that's taken us back down near 2020 lows. So one of the key themes we've been talking about is how clean positioning is as we enter into this earnings season.
Greg, do you think that stocks right now in the United States have priced in potentially reducing the U.S. balance sheet of the Federal Reserve by $1.1 trillion?
I think, as you alluded to earlier, it's incredibly difficult to accurately reflect what is going to happen when we have QT and this balance sheet reduced. But one of the things that I would highlight is that we came into this year with much more dovish expectations priced into the fixed income market. We've seen some absolutely massive moves in rates, and that's been a real headwind for equities. But the thing which really affects equities is when we get a more hawkish message, not necessarily when we deliver something that we now expect. So I spoke to Shahid Lada, our head of US rate strategy, yesterday, and he described to me the path of the Fed as almost priced to perfection by the rates market. So we have hikes priced at every meeting, a couple of 50 basis point hikes. The market knows that QT is coming. So I would argue that perhaps there is less scope for hawkish surprise now than we had at the start of the year.
Can you walk me through how you think the equity market is absorbing things so far? Because I'm starting to see weakness in the banks more recently, the home builders through much of this year. Greg, what do you make of that?
I think some of the price action and rotation between sectors has been incredibly interesting. So when we look at the correlation of equity sectors to rates, you can see that one of the sectors that should do well in terms of a rising rate environment is the financials, and it hasn't been. One of the sectors that should do poorly in a rising rate environment is the utilities, and the utilities have really been on an absolute tear. So clearly there's something going on away from just the rotation driven by rates. And really, I think that it's a defensive bias and the fact that people are concerned about the economic outlook. And there are more people that I speak to who are bearish and worried about the idea of a 2023 recession than there has been for a very long time. So under the surface in equities, we're really having this rotation out of risk and into defensives. You can even see that in the technology sector. You can see something like the semiconductors. It's a real bellwether for cyclicality within tech. And the semis are at relative lows relative to the broader tech sector.
Are you willing to buy that weakness? I think is something we've got to try and work out, Greg. What do you look at to give you the signal, this is something I want to buy?
Well, for me, the key thing, I've already mentioned it, just has to be earnings season. When we look at how stocks react around earnings, when you see analysts shift their earnings forecasts, it tends to drive stocks. We've been in a very macro environment where we've been focused on supply chains, the situation in the Ukraine, we've been focused on the message from the Fed. But if you go and look at the stocks that have had the largest forecast upgrades year to date, those have been the stocks that have outperformed. We have a basket that tracks that. It's outperformed every major index year to date. So the real question for me is, what type of message are we going to get at earnings over the next couple of weeks? Are corporates going to be worried about margins? Are we going to get a slightly more cautious tone about the outlook? Or in fact, are we going to hear that corporates are actually still very resilient and we do still have a strong consumer? We have a potentially longer-term capex cycle, and there are actually some reasons from corporate earnings to be a bit more constructive.
Hey, Greg, great to catch up. It's been too long. Greg Battle there of BNP Paribas. Just Tom, on that defensive rotation we're starting to witness in the equity market, particularly here in the United States.
Yeah, well, the defensive, look, a lot of people have been wrong, John. We've gone 4 standard deviations, -2 through the center to +2 on equity markets. We're in a pause. I don't have any opinion on this other than the bears have been confounded with their certitude that this is a bull rally in a long-term bear market. That's the belief out there, the gloom crew, and it needs to be proven out. Again, I'm sorry, earnings matter.
UBS
we'll
has
know a lot more in a week.
We'll catch up with Evan Brown a little bit later this morning. Luke Carr and him said this: one day the US expansion will end, but right now, economic fundamentals, chiefly the labor market, new orders received by manufacturers, earnings growth remain robust.
Raymond James was adamant yesterday that they don't see a slowdown being outside New York City, being down in the South.
Laurie Hine was going to join us shortly as well from State Street. Looking forward to these conversations on the equity market with futures bouncing just a little bit, up 1/3%. On the Nasdaq 100, up 0.5%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishka Gupta. Ukraine's foreign minister says his agenda is simple. He wants to give NATO to give his country, quote, weapons, and weapons. Dmytro Kuleba met today with NATO Secretary General Jens Stoltenberg in Brussels before a meeting with the alliance's foreign ministers. Ukraine has been pushing for more air defense systems and anti-tank weapons. And in Ukraine's port city of Mariupol, the mayor says that Russian attacks have killed more than 5,000 civilians. He also says that more than 90% of the city's infrastructure has been destroyed. If Russia captures Mariupol, it would open up a land corridor to the Crimean Peninsula. Moscow seized that from Ukraine back in 2014. And Fed officials have laid out a roadmap for reducing the assets they bought during the pandemic. They plan to shrink their balance sheet by more than $1 trillion a year. That is according to the minutes of their meeting in March. Some officials also thought they should have raised rates by more than 1/4 percentage point, but they held off because of uncertainty caused by the war in Ukraine. House Speaker Nancy Pelosi reportedly will visit Taiwan. That's a show of support that's likely to lead to protests from China. According to media reports, Pelosi will arrive in Taipei on Sunday. The invasion of Ukraine has raised concern that China may follow through on its threat to take control of Taiwan by force. Warren Buffett's Berkshire Hathaway has taken a stake in laptop maker HP, valued at more than $4.2 billion. That has shares surging in the pre-market trade. Berkshire has traditionally stayed away from some technology investments, but it has moved into that sector in recent years. At the end of 2021, Berkshire's stake in Apple was worth more than $161 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the House for business's greatest minds.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts, great questions. The war in Ukraine rages on.
President Putin's invasion is brutal.
Turn to Bloomberg for up-to-the-minute reporting from around the world and analysis of what it all means to you.
The intention here is to increase the pressure on the sanctions front.
I think the United States policy is that the sanctions continue until President Putin is no longer there.
For continuing coverage from Ukraine and around the world, keep it tuned to Bloomberg Television and Radio.
Just in 1 year, our sanctions are likely to wipe out the last 15 years of Russia's economic gains. And because we've cut Russia off from importing technologies like semiconductors and encryption security and critical components of quantum technology that they need to compete in the 21st century, we're going to stifle Russia's ability and its economy to grow for years to come.
The President of the United States from New York City this morning. Good morning. Futures on the S&P and on the Nasdaq bouncing back just a little bit. On the S&P 500, we are higher by 1/3%. On the Nasdaq 100, we're up by 1/2%. The news this morning from the EU. Tom, just some reporting here on how talks are going. Sanctions and that debate hitting a snag on a coal ban phase-in and exemptions as well. They're aiming to reach an agreement on this today, but that's the current snag. Just what is that phase-in for that ban? Over what time period? And other details too.
We're learning new things each and every day away from the horror of this war and, of course, the immediacy of Ukraine. Jack Fitzpatrick in Washington, and always wonderful Maria Tadeo in Brussels with us as well. Maria, I'm learning about coal. I'm learning about a wonderful Bloomberg article on how the nuclear stuff from Russia gets to the nuclear plants along Eastern Europe to help them. I'm learning new stuff every day. Is the climate debate disappeared in Brussels? Has there been a regime shift in terms of energy in Brussels?
Well, it is changing, and I would point to the Italian Prime Minister Mario Draghi yesterday, who said at this point we should not be naive. Every war carries a cost, and at this point we have to ask ourselves, do we want to have a peaceful summer where you turn on the air conditioning to the max and you have a nice time at the beach, or are you really fully committed to trying to help Ukraine to stay out of this war, but also put an end to this war? There is going to be a price tag that will come with this. A lot of this debate, of course, is this huge pressure that we're seeing, by the way, which I would argue is the biggest story today, that warning from the NATO Secretary General saying Russia is preparing for a full attack in the east of Ukraine. They want to dominate Donbass. And a lot of this, Tom, is because the clock is ticking for Vladimir Putin. Just very briefly, this parade on May 9th, the Victory Day, the Soviet Union victory over Nazi Germany, Vladimir Putin has to show something to his people.
Okay, maybe May 9th is the target, but what we're looking at to the French election is your reporting in Budapest a number of days ago. What does Brussels, what does the West do about a victorious Orban? What is the action you take against a Hungary in cahoots with Moscow?
Yeah, and he was unapologetic. He blamed, by the way, what he says is the international left. He blamed George Soros. He also blamed President Zelensky. The Hungarian government say the Ukrainians have no interest in putting an end to this war. What they want to do is escalate. And once again, he took aim at Brussels. The one thing I would say, however, when you look at Viktor Orban, and I've covered him for 3 years now, you really have to make a difference between the bravado and the language, what he says to his people and what he says in public, and then what he does in real action. The reality is he needs money that comes from the European Union. He needs the funding. And secondly, when you look at the details that we do of every sanctions package, Viktor Orban has voted in favor of everything for 4 times now. So you have to make a distinction between what he says, that bravado, that very macho line that he likes to take, and then what he does in real ground when the crunch time comes and the money is at stake.
Jack, how does the U.S. administration, how do lawmakers parse out that distinction between words and actions when it comes to China, when it comes to India, when it comes to determining who your allies are, and frankly, who your enemies are when it comes to the conflict with Russia?
with countries like China and India, the goal seems to be not to expect that you can get them fully on board. They're talking to European allies about sanctions and seeing what they can do unilaterally in the U.S. on sanctions, but at least trying to get them to remain neutral or be a little more neutral. There's been some pressure on India lately ahead of military talks with India next week. Just yesterday, the White House press secretary Jen Psaki said it has been made clear to India that any more formal, more significant economic relationship with Russia would be a bad thing for India. They still do buy energy commodities from Russia. They're the biggest buyer of Russian weapons. There's not an expectation that you can get China and India to really fully pull away from any relationship with Russia, but at least something more like neutrality and avoid them going all in on a relationship with Russia.
Maria, we heard from the foreign minister of Ukraine, Kuleba, coming out and saying we need weapons, weapons, weapons. Are you hearing that NATO, that frankly Western nations want to give them more weapons, weapons, weapons if they're worried about the potential for some sort of escalation?
Yeah, he spoke to us reporters here earlier today. He said, by this point, it's very clear that the Ukrainian army is very well trained and can repel the Russians, but we need those weapons. He also says, by the way, which is the core of the debate today here at NATO, is should we still make a difference between defensive weapons and offensive weapons? For the Ukrainian foreign minister, he said at this point, that is a silly idea. The entire Ukraine is trying to defend itself and needs everything. Of course, that brings up a big debate over should you send the tanks, the fighter jets, and so on. And is that an escalation? For NATO, it is a point of tension. They worry about this spilling over. They worry about this going in crescendo. But just to give you some color here, today, just outside of NATO, there's Ukrainians who are protesting here, and the thing that they chant and they scream is give those fighter jets to Ukraine. That is a line that we hear repeatedly. So, of course, the Ukrainians are going to continue to push for this until they get it.
Maria, thank you. As always, Maria Tadeo there and Jens Fitzpatrick. The effort in Europe continues, Lisa, specifically around the sanctions and trying to come to an agreement on banning Russian coal.
Yeah, and coal is the first step maybe toward energy bans, or is it the last step? Is this really basically as far as European nations are willing to go before they can get some sort of other source of gas in particular that they currently get from Russia?
John, I'm going to go to microdata here, and I believe I saw yesterday year-over-year car sales in Russia down 60-some%. Somebody asked me yesterday, well, how do you measure depression? That's a loaded academic question, but as a general rule, John, minus 30% GDP. Is that imaginable in Russia? And I think the answer is we don't know, but the answer is yeah, it's within the frame of where we can go. Are we moving Russia with coal and others into depression?
One thing we can say is dollar ruble is probably not a good gauge of how that economy is performing.
Strongly agree.
Right now.
Yes.
I think we've got a piece out on the Bloomberg this morning on the labour market, Tom, and the problems they're going to have in the labour market, given how many companies have pulled out of that country.
Traded abroad, I'm looking at the 2042 Russian piece, and it trades weaker this morning. It's not through on price to new lows, but it's getting there, and the yield is 20-something%. That's maybe a more accurate indicator of market belief than what you see in the currency.
Do you know what I'm looking at? Twitter in the pre-market, up 1.4%. And this tweet from Elon Musk. Twitter's next board meeting is going to be lit. And it's a picture of him, Tom, smoking a blunt with Joe Rogan. Do you remember that several years back? That's a legit Elon Musk tweet this morning.
Some people are saying, where's the SEC on this? I'm not up to speed on that story, but you wonder.
I'm not sure they're against him smoking a blunt, Tom. Are you suggesting they should be?
What's a blunt?
Okay, guys, let's cancel order for time being to sell, to buy euro. We will buy at lower level, okay? For time being, order to buy euro cancelled. And we will keep an eye on these because I believe we can buy at the lower level. Stay safe.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Live from New York City this morning. Good morning. On TV and radio, your equity market picture looks a little something like this. We're positive across the board on the S&P 500, up 1/3%. We bounced back on the NASDAQ by 0.5% after declining 4 percentage points and some over just 2 trading days. Some real weakness in the NASDAQ. And you'd have to say the rotation beneath the surface has become really defensive. We'll talk about that a little bit later in the program. Let's talk about the bond market too. 2s, 10s and 30s, and look at 2s. We closed out last year, 2021, at 73 basis points on a 2-year. Right now, 243.50. Yields coming in just 3 or 4 basis points, but clearly we've added a lot of weight to the front end of the curve. We're looking for some big moves from the Federal Reserve, and Bank of America now looking for three 50 basis point moves from the Federal Reserve in a row. And that's no surprise because this is becoming consensus very, very quickly. One thing that has turned around though, and Lisa, we can sit on this for a moment, 2s, 10s, -9 basis points Monday morning at the open, and right now a bit of steepness kicks in, +13 basis points. But you see the flattening trend over the last year or so. And Bramo, you've been asking the right question repeatedly. Does QT mean higher yields at the long end or lower yields at the long end? And there's still real debate about that.
Yeah, and it seems like there's a consensus forming in parts of the bond market where people are saying perhaps in the short run it leads to a widening of the yield curve and actually a steepening of that longer term yield. And then longer term, as the ramifications come into effect and you get that slowdown, people will pile back into bonds. But it's hard to wrap your head around right now. This is uncharted territory.
What do you make of the pace that the Fed is setting us up for here relative to what we were doing back in 2017?
So it's dramatically faster. However, the balance sheet is dramatically larger and the inflation is dramatically faster as well. So people are looking at this. It was within the range that people had been predicting. The reaction in markets, interesting, sanguine. Is the market accurately pricing in $1.1 trillion of balance sheet reduction a year, which is the pace that the Fed is setting up for?
I think we're trying to work out exactly how to price it. Lisa, thank you. And Tom, just quickly, it's when you get a cigar and you hollow it out and you fill it with something else. A blunt.
Oh, that's
right?
a blunt.
That is.
Okay, thank you. Good to know.
Value add.
News value add.
That's what people tune in for. A bit of bond market and a bit of
blunt.
Whatever that is. All right. Carry on, Tom.
Futures up 12, the Dow up 24. Elsa Lignos joins right now, global head of FX strategy at RBC Capital Markets. And we can go to her physics at Cambridge and look at 14 topics. We're not going to do that, Elsa. I want to look at the one true thing you're focused on, which is your ECB. You've provided huge research over the last decade on ECB. What does Lagarde do? Is her degrees of freedom so shrunk down that she has limited choice April 14th?
So at this stage, they'll be doing very little. They're setting ourselves up for a normalization coming further in the year. But I think what gets really interesting is what they do further out, because the market is pricing hikes, and it's clear that's the direction of travel. But the question is, how far? Do we just get to zero and stop? Do we go any further than that? And the reality is that unlike the US, where you have this really strong domestic demand, in Europe, it's a bit more about inflation without as much strength in the economy.
How do you respond to the certitude that they will raise rates? Begin to raise rates or get out front of raising rates to keep up with the Fed?
Well, the reality is they're not going to keep up with the Fed. And I think that's what's going to just give increasing support to the US dollar as the year goes on. I mean, our call for euro dollar is still a trough around 107 and quite comfortable with that. But, you know, if I had to look at where the risks lie around that, you know, unless the Fed changes course or, you know, something happens to derail the US tightening, and it may well happen later on in the year, if things turn out as markets are priced at the moment, we're going to have a really significant yield advantage for the US over the euro area by the end of the year. And that in itself will be very meaningful for the currency.
Elsa, what's the ramification for the dollar of this balance sheet reduction that we're trying to game out and coming up with question marks?
So I think it's a little bit more indirect than most people perhaps might think, because all of our research historically has found that there's no one-for-one link between the size of a central bank's balance sheet and the domestic currency. A lot of it depends on the status of the currency as a haven or as a risk proxy. And because in the case of the dollar at the moment, it is trading as a bit more of a haven, you do tend to find that if equities sell off, the dollar finds a little bit of a boost. To the extent that the market, like you said earlier, is not necessarily priced for a full 1.1 trillion of reduction in balance sheet per year, you may well see that weighing on equities and boosting the dollar as a result.
Elsa, you talk about the global picture for the currency, and so I have to go to a philosophical point, especially as you see China start to pay for coal from Russia in yuan, and you start to get this concern, especially as U.S. Treasury Secretary Janet Yellen yesterday said that they could actually impose some sanctions similar to what they did on Russia to China should they invade Taiwan. How much are you looking at the diminishing of the dollar's place as a result of what some people are saying the weaponization of its clout on the global financial system?
Right, you know, a lot of what we've seen with Russia in some ways has been unprecedented. But I think the key task is what's going to take its place. We had a really interesting conversation about this exact topic just a few hours ago with a client, talking about de-dollarization. And there are two big obstacles, I think, for China. One is the closed capital account, you know, the fact that they don't allow free, unfettered access to their capital markets. And the second is liquidity and the ability to hedge exposure via the US dollar or via dollar leg funding markets. So I think until you get a very broad shift on both those topics, you're not really going to see a proper challenger. Of course, it's going to happen over the next decade or 15 years, but most investors don't think on that horizon.
Elsa, the bet here is on all these currencies amid massive uncertainty. Can you make a big figure bet on dollar or a big figure bet on DXY or the Bloomberg Dollar Index? Is that even feasible now?
I've got to say, Tom, we've had a lot of success this year with quite short-term tactical trades. It's definitely paid off a lot better than trying to kind of position for those big, longer-term trends. You know, at the moment, I think we've been watching Eurodollar kind of bounce around in that range. We obviously have the French election coming up that's attracting a lot more interest and attention. My bias longer term is still for a grind lower, but clearly there's a lot of risks around that.
I look at the Pacific Rim, and you know, Lisa mentions China and the challenges there as well. Is there an opportunity, a surprise opportunity in the Pacific Rim here, given the COVID story in China, given sort of a Pacific Rim gloom out there? Where's that opportunity?
Yeah, it's a really interesting question because actually I see quite a lot of optimism baked into parts of the Pacific Rim. You know, if you look at the Australian dollar, even the New Zealand dollar, we model it based on the usual fundamental drivers, two-year yields, commodity prices, and so on. And actually for the last few months, there's been this big unexplained residual. So a lot of optimism kind of getting baked in to the top side. I do think that as the year goes on, you know, if the Fed is really going to deliver as much as it says it will, or as much as markets expect it might, then that yield advantage for the US is going to undermine not just the Pacific Rim, but global currencies more broadly.
Elsa, before we let you go, you were talking about some of your conversations with clients. What are the biggest concerns for clients right now? What is their biggest worry that they present to you?
You know, I think there are a number of questions, topics on people's minds. Clearly, you're looking at the situation in Ukraine. Everybody's sensitive to the fact that it can worsen materially at very short notice. It's a political decision what extent of sanctions are imposed, and that political pressure for further sanctions could change. You know, beyond that, I think people are a little bit perplexed, you know, looking at the relative strength of equity markets, for example, and kind of scratching their heads trying to figure out where that's coming from. Granted, you know, I'm talking to macro investors, so probably if you speak to an equity investor, they feel a lot more comfortable with it. But there's certainly a lot of anticipation of perhaps some weakness further out the line.
Alcelinos, thank you, of RBC. Looking ahead to next week, really, that's your next stop for this market, just in terms of the schedule. Yeah. Initial jobless claims this morning. On to next week on the 12th, we get CPI that morning, Tom. Then on to the 13th, JP Morgan earnings. On the 14th, I believe, the ECB.
Yeah, John, I strongly agree with you that we're really shoved already into next week. And, you know, I'm death on Friday as the weekend because we work all through the weekend. But I got to admit, this Thursday, even with claims out here in 2 hours, has a real Friday feel to it just because we wait for next week.
Our survey's a moving target, Bramo, but at the moment, going through some of the numbers, most people looking for a number north of 8% on CPI in America.
I'm going to be a little controversial.
Number.
It is a stunning number, and I don't think it's going to matter. I think what's going to matter is April 13th when JP Morgan reports their earnings. I think the earnings season is going to be so much more important in terms of what the Fed will do. If they beat estimates, if they show those profit margins continuing to grow, what then happens to the Federal Reserve? Do they start to take a page out of Bill Dudley?
Well, I don't know if it will change anything for the Federal Reserve, given we expect a 50 basis point move in May and the start of balance sheet reduction.
Is that a hawkish stance? To Greg Bottle's point, John, is a 50-beat move assumed in May? Is that a hawkish stance?
That's already assumed, Tom, and I think that speaks for itself. That's the consensus view now, and they're not pushing back against it. To Lisa's point, though, on the earnings, I think that's what's going to matter more to the markets. We'll take the rate hikes, the balance sheet reduction, if the corporations can give me a decent forward look on the year ahead. And clearly at the moment there's some concern in this market based on what we've seen with the utilities rallying, the home builders struggling, even the banks not performing with higher interest rates on the horizon, Tom. They're all the kind of signals that things are getting a little bit defensive. And I'd go one step further. The worries are starting to be introduced about the economy in the year ahead.
There is micro data that clearly indicates that. And also, as we heard yesterday, where maybe even the wage is flowing out. John, what I know is it finally spring in New York City? What do you think?
I hope so. When the Masters starts, will you indulge me and allow me to go through the tee times? I'm going to anyway. Tiger Woods, 10:34 Eastern Time, teeing off at Augusta National for the Masters, Tom.
John.
It is the most relaxing sporting event in the world. I can sit and watch that thing for hours, for days, uninterrupted. It is just beautiful there, Tom. And
Chapter
one day,
15
out of all the things,
meditations.
This does have a page in the book that is yet to be released. Of all the things, Tom, that you want to do to put on our tour for this program, that's got to be up there.
I could see it. You know, I could see you with the green jacket. Can I talk about a hawkish stance? I mean, the Hawks are out. There's just no way about it. The Hawks are out with a vengeance on Central Park. And, you know, we're trying to avoid a hawkish stance. That's all there is to it, a hawkish surprise.
Is there something you want to share?
Well, I guess I'm not going to share it.
Okay. Why hasn't that worked out?
I have no idea why it hasn't
Was there a
worked
joke
out.
here?
Yeah, well, you know.
It'll come later in the hour.
Where's the punchline? Okay. Do we have to wait for the punchline? I'll wait for the punchline. All right. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. The United Nations General Assembly is set to vote today whether to suspend Russia from the Human Rights Council. The US and others have accused Russian forces of carrying out atrocities in Ukraine. Russia has repeatedly denied those allegations. The next economic jolt to Russia will probably come in the labor market. According to a Bloomberg survey of analysts, employment there this year is set to be more than double, exceeding 9% for the first time in more than a decade. Sanctions have put the economy on course for one of the deepest recessions in Russia's modern history. In China, the government is acknowledging that domestic and global risks to the economy are bigger than previously expected. The cabinet signaled it will step up monetary stimulus. Chinese authorities have made repeated promises in recent weeks to stabilize the economy. COVID restrictions have curtailed spending and business activity. In Washington, the FBI arrested 2 men accused of posing as federal agents and giving free apartments and other gifts to Secret Service agents. One of those Secret Service agents worked on the First Lady's security detail. 4 Secret Service employees have been placed on leave. And we may be on the verge of a bidding war for the Benetton family's highway and airport group, Atlantia. It could become this year's biggest deal. Global Infrastructure Partners and Brookfield Asset Management say they have made a non-binding bid for the Italian company. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.